Assalamualaikum and good morning, ladies and gentlemen. We will start this session now. On behalf of MIA and ACCA Malaysia, welcome to today's MIA-ACCA Train the Trainers workshop, jointly organized by the Malaysian Institute of Accountants, MIA, and the Association of Chartered Certified Accountants. My name is Nur Atika from Competency Framework and Development Department of MIA, and I will be your host for today. Together with us today, we have a few representatives from MIA and SCCA. First of all, I would like to thank everyone for attending this workshop. We hope this workshop will benefit all of you as well as students. The 13th series will be discussing on topic MFRS 107 on cash flow statement. The purpose of this workshop is to assist lecturers in improving their pedagogical and professional development programs and enhance the capacity of academicians relating to regulatory changes. This workshop will enhance participants' confidence in preparing the statements of cash flows in accordance with MFRS 107. For your information, the Train the Trainers workshop is part of the initiative of the MIA and professional bodies to enhance the capacity of academicians and to ensure the academicians are updated to the latest changes of the standards, rules and regulations related to the accounting education and profession. This is also the platform that practitioners and industry can share their experience and knowledge to academicians and to update the latest information. A special thanks to SCCA Malaysia for their continuous support to collaborate with MIA in conducting the Train the Trainers for academics. Since 2015, we have worked together for the TTT, and today we have reached 13th series. On behalf of Puan Siti Hamizun, she sends her regards as she unable to join this session. Without further ado, let's invite Mr. Selva to start his session.
Thank you,
Mr.
Nurul
Selva.
Atika, and good morning to you and also to Ms. Hasmida Ismail. Thank you and good morning and to all the participants today. So as you know, today we are talking about a topic called the statement of cash flow. So I'm not sure how you look at that statement. Some find it very easy, some find it very difficult. So it all depends on how you look at that statement. So I'm trying to make it as simple as possible today for everyone to understand so that when you teach this topic to the students, they will be able to understand it as well. Now, before I start, let me put on my slide on the screen. Right. So this statement of cash flow, just a brief on it first, to understand what it is so that the students eventually understand the role of this statement of cash flow vis-a-vis the other statements of financial reporting, which are the statement of financial position, the profit or loss, and the statement of changes in equity. Now, what we always like to look at, or what investors would always look at, will be the profit or loss and the balance sheet, because they want to look at what are the assets that are available to generate the business, which is to generate income and to eventually show a profit, because ultimately whatever they invest, they want back as dividends. That's quite elementary, right? Simple. So what they would look at for investment purposes, or in order to buy a company or to invest in a company or to take an equity share, they will probably look at the balance sheet and the profit and loss account. First thing they'll be looking at is the company profitable. All right. Second thing, they'll be looking at the balance sheet to see, are you over-geared? That means, is your borrowings extremely high in relation to your capital? Then they will be also looking at your assets that are being used to generate the income. And then they will look at what are your liabilities as well. So now, having looked at all this and looking at the profit, sometimes the profit is very good, all right? But the money is not there. How is that so? The profit is good, but the money is not there. So the only way to find out what is the cause of the problem will be to look at this statement of cash flow. All right, I'm just giving an overview first. After I give an overview, we'll go into the slides and look at things. So what is the cash flow situation? So that's why that statement of cash flow is actually a very important document. In fact, it is the most important to see whether the company, which is showing a very good profit, looks very healthy on the balance sheet, profit and loss account, but on the cash flow side, the cash flow is very bad. Now, that is where you can really understand a company. So the question is, why is the cash flow bad? How come if the company is profitable, why is it bad? Now, if you look at things in practice, all right, there are always companies who have a marketing department. You also have purchasing and others. Now, let's focus on the marketing department. What is the marketing department's function? Is to generate sales, all right? And when they generate sales, that's when the sales come up, the profitability goes up. The more they can generate, the more the business that comes into the company, and therefore they survive. So that's why marketing people always like to call themselves as one of the greatest in the company, because without them, they always say that you cannot survive without us, because if we don't push the marketing, where are you all getting your salaries from? I mean, that used to be the thing that most marketing people will talk, right? To boast of their ability. But that being aside, that's their job, and they do their job well. But the problem is, look at the marketing aspect of things. They are always pushing for sales, and particularly depending on what you're selling, depending on what your services are, depending on your products, usually there are seasonal. Now, let's take an ordinary product, which is retail, normal retailers may sell. Usually, the demand for these products will be pushed up for every festive season, all right, by nature. All right, end of the year, festive seasons, Chinese New Year, maybe Hari Raya, maybe usually Hari Raya these days comes very close to the end of the year or very close to the Chinese New Year, depends on how the dates come up, right? So usually sometimes there are individual, what should I say, festivities. Sometimes they are joined together and the sales get pushed up. I mean, the demand goes up. So marketing people always push the sale. So the problem is this: when you push the sales on a business to business, all right, not business to consumer, because consumer today does not buy on credit. He only buys either using cash or uses his credit card. Okay, so no business or a retailer, having that buku tiga lima that they used to have those days, and you write down, those are gone. So we are not talking about business to retailers, business to consumer, mostly business to business, where goods are sold on credit period, etc. Right? So the salespeople are doing is they are pushing to all the businesses, pushing to the hypermarkets, pushing to all the other businesses that they want in order to generate sales. But the thing is the collections. Now, this is the key point in any business. The money is the lubricant. So when they sell, they normally do not bother about collection. Generally, some do, some don't. So they leave it to the accounts department. They say, this is the purview of the finance department. You are people in the finance, you chase the collection. I'm busy doing the sales. I got no time to do collection. So this comes up with the situation. There's nothing wrong with that. There comes up with the situation when there are credit limits imposed on customers by a company, which says that, all right, your credit limit is, 300,000 worth of goods you can take. Your payment period is 60 days. So if you don't pay in 60 days, your credit limit, once you reach 300, we can't sell you any goods unless you pay, which is quite fair because they would have sold the goods and they should be paying. Now, they cannot be taking more goods and more goods and more goods and not paying, right? What they will be doing, in fact, will be selling the goods and rolling the money themselves, whereas this company does not get the cash. So this exactly is the problem. Salespeople during festive season, they will push the products. And then when the customers reach the credit limit, haven't paid yet, then the accounts department is going to say you cannot sell to this customer this and this. And what the marketing will respond is, all right, now is the peak season, the sales peak season. If you don't want me to sell now, then I'm not going to bother. I'll sit down and shake my legs. If the boss asks why no sales, I'll say the accounts department say credit limit reached already, so we cannot sell. All right. And then they bring this up to the managing director or the CEO or whatever. After discussion, the credit limit is increased. All right. Because, oh, festive season, we increase. Now, this is the problem. Psychologically, usually, once you begin to owe bigger amounts of money and longer periods, invariably collection becomes slower. So there will be always this problem. You know, the collection comes in slower. Sometimes it doesn't come in the right time. So you get this dragging of the debts. What is happening in the company? Two things are happening. Number one, because of the pushing of the sales have gone up. The profit has gone up, but the collections is not going up. In fact, it's going down because when they sell more, they need to purchase more goods. And the creditor who is selling them the goods will say the same thing. If you don't pay, I'm not going to give you any more goods. So they have to also take on more goods, pay the creditor. So on the one side, there's a cash outflow. And on the other side, the cash inflow is not coming in as fast. Now, the time lag can cause a lot of problem because payments have to be made. You cannot tell payments don't pay, salaries don't pay, all the expenses of the company don't pay. You can't. So you see, this is where the cash flow statement will reflect the actual story. Profit, very good. Cash flow, hardly any cash because of collections. So that's the moral of the story, and that is the gist of what we are trying to study today. All right, the cash flow statement and why the cash flow statement is so important. So whenever you look at financial statements next time, look at the profit, look at the cash flow. If the cash flow is very low, all right, now most likely they are not collecting. But then again, that may not be the only conclusion. Sometimes they are collecting the cash, but reinvesting it either to buy new equipment, machinery, new goods. So there will be the flow. So that's where you need to go into the various components to find out why is the cash low. All right. So with that, let me start the session now. All right, I'm going to start the slide. If the slide doesn't move on, we can get some assistance from Ms. No Atika. All right, let me move the slide first. All right. So as we all know that one of the most important objective, as you can see on the screen, as what I just explained to you, is this cash flow statement provides information on something called cash and cash equivalents. All right, I'm going to explain cash and cash equivalents as we go through the slide. All right, it has a definitive meaning, and sometimes the meaning is misunderstood. So the idea is to determine how much cash do you have and classifying those cash flows into three main areas of the cash flow statement. Number one will be the operating cash flow. What is operating cash flow? From your normal operations, your daily operations, your sales, the expenses that go out, the sales expenses, the administrative expenses, and other expenses, all of that expenses must be taken care of. Those are after operations. Now, another classification is investing. Many companies will need to buy machinery, invest in furniture, invest in maybe purchase an office or something. Whatever they are buying, they are investing. Sometimes they have too much cash. So rather than keeping the cash idle at the bank, they've invested in the shares, they invested in bonds in order to earn income. Okay? So that could be investing as well. And the final one is the financing activities. Now, not everyone will be using their own capital to carry on business. You may need to borrow from banks. In fact, in real life, you cannot actually use your cash all the while to run the business. Now, in a way, it is, some people say, what for I pay the bank interest? All right, so why don't I use my own money? Well, that's a good philosophy, but then it only is good up to a certain extent because everyone has limited amounts of cash. Even though how many million you have, it is that amount, right? But most businessmen are not going to be in that case. The average businessman has a certain amount of money. So he can only invest all his money and then keep his fingers crossed. So the idea will be to have a portion borrowed from the bank. And the banks are also, if your business is viable, willing to lend any businesses because the survival of a bank is on the interest income. The banks cannot buy and sell goods, right? They cannot do that. Their business is restricted to earning either this kind of interest income and stuff like that, right? Nothing else. The fact that they give a loan and they have a security on the loan, maybe a property, it is not their business to keep that property and sell it because that's out of their scope. The property that they hold as a security is exactly what it is, a security. All right. Only in the event that the loan customer does not pay, do they move to that direction to sell. It's not their business to sell property. All right. So therefore, they need interest. So if the business is viable, they are always willing to share. So you get more money. You keep some of your money. You get money from the bank. Share it out. All right. Of course, the interest is a certain amount, but still, the risk is now shared between you and the banker in that sense. All right. So you will share your profit and then you can expand better. So that's why you need to do some borrowings from the bank. So that's where you talk about financing. All right. So financing can also come from shareholders in the form of shares or preference shares or in the form of issuance of bonds, etc. So these are the three major categories within the cash flow statements. All right. So this is where we are going to study this today. And if you have any questions, please ask them. I think there's a chat box. Put them on the chat box. I'll pick them up off and on as I go through maybe during the tea break or after, we will answer them as we go along. So don't be shy to ask the question. Please feel free to ask them. So moving on, application, this cash flow is for all entities, profit orientated, also not profit orientated, because you still get money. Where does the money flow to? And then this word, cash and cash equivalent. So what is cash? Cash is cash, right? Cash equivalent, things that represent cash. Now, if you got a fixed deposit, you put money in the fixed deposit, you can draw it out as whenever you like it. If you have an emergency, you can draw it out. You will lose out the interest. There may be something like that penalty on the interest that you are supposed to earn. You may lose all that. But the thing is that your capital is still intact. When you put on fixed deposit, they never, cut down anything out of your fixed deposit when they return. It's only the interest will be penalized. So you won't earn the interest or you earn a smaller interest, whatever. All right, so that is considered as a fixed deposit. So the definition of cash and cash equivalent is basically it is very short term. Short term because you need it to run the business. Whenever you need the money, you should be able to take it out. It should not be that, you can't take it out, or you please wait for 2 months or 1 month later, we will process you. All that cannot happen. That is not a cash equivalent, right? So they're actually highly liquid investments as well, investment in cash, that are readily convertible to known amounts of cash. You cannot say, I do not know how much I will get out of this investment, right? Now, if you have that uncertainty, then that is not a cash equivalent. It must be a known amount of cash, like a fixed deposit. There is no way you will lose out on fixed deposit, all right? Anyway, also you will get back your fixed deposit unless your fixed deposit is greater than 250,000 and you are putting a huge amount in a bank, and in the unfortunate incident that the bank has to close down, which in Malaysia never happens. All right. It never happens in Malaysia. All right. So only when it closes down. Now, why it never happens in Malaysia is because, as you probably know, our Bank Negara and the Banking Act is very strict. All right. Bank Negara is constantly surveilling all the banks, having a surveillance on all the banks on a daily basis. They have their auditors there every day. I mean, every bank. So what they are monitoring is the minute a bank is getting a little bit weaker, you may not know it, but the back end, once they know, they will initiate proceedings to get the directors to merge the bank or put in additional capital. If they cannot put in additional capital, there will be talks in the background to merge the bank. So you will never have a bank collapse. Have you seen a bank in Malaysia ever collapse? Never. All right. You never see people waiting outside the bank to try and collect the money because the bank's going to collapse. All right. So in that respect, the bank won't collapse. But the thing is that this is the rule in the banking system. The PDRM, the PIDM, sorry, PDRM, all right, PIDM, the insurance that protects your banking amount is only up to 250. So anything more than 250, in the event the bank collapse, which never does, then you can only get up to 250. All right, but that is not the situation we are looking at in a cash flow statement. All right, so definitely it must be distinct. So it's convertible to known amount of cash and have original maturity dates. This is important, of 3 months or less. That means your fixed deposit should not be 6 months or 8 months or whatever. It should be 3 months or less. Now, what happens if you have a fixed deposit that is 1 year? Will that be a cash and cash equivalent? The straight answer is no. But there is another thing to this, right? Another caveat to this. If you have an arrangement with the bank that if you need the money straight away, you can draw it out. Sorry. You can draw it out from the bank without any penalty on your capital, then that becomes cash and cash equivalent. But you must have something very firm. If you do not have something firm, then you cannot say that that is cash and cash equivalent. Now, I will talk to you more on that in a later slide when we look in greater details on the cash and cash equivalent. Now, classification of a cash flow. As I mentioned just now, there are 3 major classifications to understand where are you getting your cash from. It depends on what you want to see. All right, you want to see whether profitability, are you making money? You may be making money but not collecting, the cash flow will show it out. All right, you're making money, profitability is there, but cash flow is not coming in, as what I just mentioned to you, because collections are not coming. The cash flow statement will show you how much you actually collected from your operations. All right. So this will be the core revenue producing activities of the entity, which includes receipt from customers. That means you sold the goods you expect to receive, right? If you didn't receive, it's not there. And then payment to suppliers. In most cases, it's a vicious cycle. If you don't pay the suppliers, you don't get goods from them. If you don't get goods from them, you cannot sell. When you cannot sell, sales goes down. When sales goes down, your profitability will also fall. And then people who are buying goods from you find that, or you're having problems, they also don't want to pay you. It's a double whammy. In real business, that's a double whammy. So not only your sales goes down, your collections become even worse. So that's why it is very essential for those managing a business effectively to make sure that their balance is very well done. The balance of selling and collecting. Sell, you must collect. You might have some small element of bad debts, but that's fine. Your profit should be able to buffer that. All right, small. But if you're going to be significant amount of, number one, dragging on the payments, and number two, some of them not paying totally, then it is a catastrophic situation for a company. You can easily look at that from many balance sheets. All right. So that is on the core activities. Now, then you have the investment activities, which are actually whether you're going to acquire or dispose any assets. Assets can be anything. Plant and machinery, you may acquire furniture, you may acquire office equipment, you may also acquire things like, a piece of land or something because you're a developer, you need land. So all these are things like, investing. Now, operating is different from investing. If you buy large tracts of land to develop in the future, it becomes investing. All right. So other things that you might invest will be based on the business that you are in. So those are investing, and so includes cash spent on property, plant, and equipment. Sometimes shares, bonds that you invest in order to earn short-term income, fixed income like bonds. They give you a fixed income, but the risk is very high. Shares, they don't give you a fixed income, but you like to monitor the price of shares. You may be making price changes and therefore capitalizing on the sale of the share. All right, or you might get dividend. Now, dividends are not contractual. Dividends are not fixed because dividends could be 1 year gone, next year may have twice, the next year don't have anything, things like that. But a bond has a contractual cash flow because it's either a rated bond of 7%, 8%, 9%. Those you will get constant. The risk is there. All right. Anyway, those are called investing activities. And then you have the financing activities. As I said, basically owners putting capital are financing. But you cannot expand with only that money, as I say. And don't put all your eggs in one basket, the old adage that still stands. Okay, never put all your eggs in one basket. So share the risk with the banker. So transactions with the entity owners and also creditors. Now, remember, when creditors give you credit, that means you buy goods, no need to pay, right? They give you, let's say, 60 days credit. So for 60 days, the goods that you buy, you are selling. When you're selling, the cash is coming to you. If you sell to consumer, it's cash. If you sell to business, you have to give 30 days. If you give 30 days, then at least you collect, you got 1 month buffer. If you give your debtors, the people you sell, 90 days, and the creditor give you 60 days, this is bad business. All right, it's definitely bad. You have already a cash shortage there, all right, which is not the right thing to do. I mean, yeah, some people may do it desperate for business, but then we are not talking about that kind of extenuating circumstances. We are talking about normal. All right. So apart from creditors, you also may borrow money, and you may also, issue shares. You may also issue bonds. All right, this is bonds on your side. The listed companies, big companies issue bond. Smaller companies can still issue a private bond. All right, it's still possible, but you need to go through all the Securities Commission regulatory requirements. Even you're a private company. Okay, and then issuing or repurchasing equity. Sometimes you have too much money. You made very good, money during the few years, and you have surplus cash. You want to return it to the shareholders. So you have a capital reduction. You pay back to the shareholders. Or if it's a listed company, you go to the market and buy back the shares. They call that share buyback. All right. After all the necessary procedures are done, you can buy back the shares. That means return money to the shareholders and reduce your capital, reduce your excessive holdings of cash. So all these are financing activities, including repayments. Okay. And then we have something called the preparation of a cash flow statement using a direct method or indirect method. All right. Now, what is the direct method? Now, few companies use the direct method. Bankers use the direct method. But in the commercial world, few companies do use it. But the majority of companies prefer to use the indirect method. Okay, what then is the direct method? The direct method is we start with the sales. How much did you sell? From that sales, how much is still owing by customers. So you deduct the receivables. So whatever you sold and whatever you haven't collected, the balance you are deemed to have collected. So then you put that as your cash collected from sales. All right. Same thing with purchases. How much you bought, how much you are still owing the creditors. And so the net amount is how much you paid out. So by that way, all of the items that go in will be on a cash basis. Whatever you received in cash, whatever you paid out in cash during the year, this is called the direct method. I find that a little bit more cumbersome in practice. That's why most companies don't use it because, in a way, it is totally different from the profit and loss that you prepare. So you have to start another set of statement. But those companies who have been doing it regularly, no problem for them. And they are far and few in between, all right, who use the direct method. So it shows the operating cash, receipts, and payments, all right? Now, indirect method is the most common because you have a profit and loss account already prepared. You know the bottom line profit. Start with that profit. Start with what we know and then work ourselves down. All right. It may look a little bit longer, but it is definitely much easier. So this starts with a profit and loss, and just for non-cash transaction, that means things that are non-cash. Depreciation is non-cash. Impairment is non-cash. Loss allowances, otherwise known as bad debts, is all non-cash. All right, you adjust for this, and then you will come off with any deferrals of payment, accruals, all of this are non-cash item. Take it out, you will then get the cash from the operations. Now, I'm going to show you on the screen in a short while an actual cash flow statement to reinforce our idea of what it looks like. All right. But before that, let me finish this slide. So you also have a foreign cash flow. Now, there are always, important things in a cash flow, which is actually the translation dates, translation rates. You will have exchange differences. Now, are exchange differences a result of operations or a result of purchasing machinery? If you buy machinery from overseas, all right, there could be exchange differences, or are they also relating to financing? If you take loans from overseas, or you have overseas holding companies and you borrow money from your holding company overseas and repay them back, there will be cash differences. So foreign currency cash flows are always, stated also, and they are always translated on the date of the cash flow. Unlike in the balance sheet profit and loss account, there are two rates to be used. All right, the rate on the spot rate and a rate on the transaction date. All right, the spot rate is usually the transaction date. The other rate will be the balance sheet date. For example, if you buy goods, say from Singapore in September, let's say September 8th, you bought goods. All right. And those goods are in Sing dollars. So in your books here in Malaysia, what are we going to do? We are going to convert it into Malaysian ringgit. All right. Because that is the rate of conversion into Malaysian ringgit, because our books are kept in Malaysia. Unless, of course, you're keeping in another currency. We won't go that route today because that's not the topic of discussion. Otherwise, it becomes very wide, over wide. All right. So anyway, you convert it on the 8th of September rate. So you will be debiting purchasers and crediting the creditors on the 8th of September rate. So your books are in balance. So Sing dollars to Malaysian ringgit. Now, during the year, that item that you purchase is in inventory, and you come to the end of the year. That inventory is not sold. It's still there. Right? It's still there. And you have not even paid your creditor yet. It is still there at 31st December. Then you will translate at different rate. You see, when you translate the amount owing to Singapore, which you already translated earlier, but remember, it's still owing in Sing dollars at 31st December. You translate at the balance sheet date. And so the date on which you initially translated and the balance sheet date that you translated, there is an exchange difference, a floating exchange difference, right? So that's on the creditor side. Now, the inventory that you purchased on the 8th of September, you already translated into Malaysian ringgit. It's still sitting in the stock at 31st December, not sold. Do we retranslate it? No. It remains, it remains at the original rate, the date of the transaction. So you see, what gets translated, what does not get translated. So this monetary items get translated, all right? Non-monetary items don't get translated. Inventory is a non-monetary item, all right? Amount owing by, owing to, they are all monetary items, okay? Settled in money terms. Inventory is never settled in money terms. You have to sell it in order to collect the money. Okay, you only sell the credit, you only pay the creditor. That's not the inventory itself. So that kind of translation will end up in the foreign currency cash flows that you see here on the screen. And then you also have interest and dividends. All right, so you will receive interest during the year. You will pay interest during the year. Depends on whether you got fixed deposit, you got investment, or whether you are borrowing from the bank, or you will have both, a mixture of interest paid and interest received. Now, this is another thing that will come into the statement of cash flow. So interest and dividends received and paid can be classified here. You see the confusion. Operating also can, financing also can, investing also can. Well, it's not quite right what I just said, also can. You have to identify where is the best location to put it in. And I'm going to go through that later in this program today. All right, to avoid the confusion of wondering where shall we put, put here or there or where. So what are the principles on where it will go? I will address that. All right. And then they must be consistently classified from one year to the next. You cannot 1 year put it on operating and then next year, oh no, I think it's financing. Better put financing. Third year, no, we have been doing wrong. Put it in investing. You can't do that. All right. Remember, there must be consistency in any financial reporting. All right. Now, taxes on income. Two things in life you cannot miss: debt and taxes. So taxes are always there. So cash flow arising from taxes, all right, should be separately disclosed. And usually taxes are always classified as operating. Now, it does not mean everything that you pay for tax is always operating. There could be other taxes. You might sell land, and that land is a long-term fixed asset. So this long-term fixed asset, when you sell, you are subject to real property gains tax, RPGT. Now, is that operating? You are not dealing in the land. So should not that go into actually some other classification? Now, this is what we are going to look at. Unless they can be specifically identified with financing or investing. So if you have your land, all right, and you sell the land, and that will not be from financing, definitely. It's not going to be from operation. It will be from investing. So if the sale of the land is investing, the relevant RPGT taxation will also be tied up to investing. If you can, that's why, if you cannot break it up, it will all be defaulted into the operating activities. So it's defaulted. But if you can break it up, then you can break it up separately. But technically speaking, in real life, all right, RPGT and all of that stuff normally do not override the amount of corporate tax that's paid. Usually it's much lesser. So people, most companies will lump it up in the operating, which is the default, and it's allowed by the standard. But if you can break it up, that's entirely up to you. All right, so taxes generally go to operations. Now, non-cash activity, there are many non-cash activities. Now, what has non-cash got to do with the cash flow statement? Nothing. All right. So it will never go into the cash flow statement. So investing and finance activity that do not require the use of cash must be shown in the financial statements, but not in the statement of cash flow. All right. Showing the financial statement in the notes on the accounts, wherever it is, but never in the statement of cash flow. If it does not touch cash, it never goes into the statement of cash flow. All right. So the key points, as I said earlier, for reporting purposes, the statement of cash flow must report cash flow during the period classified by operating, investing, and financing activities. All right. Now, before we go into what is the significance of the statement of cash flows, let's just take a short a time to look at a real cash flow statement. A real one in real life first. So I'm going to show you one. The names are changed, obviously, for obvious reasons, but the numbers are there. So let me just get out of this slide and, all right, share into something else. All right, I hope you can see the screen quite well. I'll try to make it as big as possible because I know that on a screen it's not exactly the biggest. All right, let me see what's this. All right, so this is this is a real company. All right, of course the numbers are all changed, the name is changed for the purpose of understanding. This is a cash flow statement. So I'm going to see the main elements of a real cash flow statement. This is a company with subsidiaries. So there is a group and there's a company. We don't need to bother about this. All right. But later I will touch on it a little bit to highlight something. So here is the cash flow from operating activities. And then as you go down further, we have the cash flow, all the yellow color ones. All the yellow, this is the cash flow from investing activities. And as we go down further, this will be the cash flow from financing activities. All right, so these are the three major things. So from here, we are going to see, we're going to drill down a little bit what we just looked at and what we just read. Let's have a look at the real cash flow. Now, when you say cash flow from operating, starting with the profit before tax, this means this is called the indirect method of cash flow. The indirect method. This is not the direct method because we are not starting from the sales minus what is owing by the debtors. We are not starting with that. We are starting with the profit. And the profit is 38 million in this case. Now, to understand this, I will move to the profit and loss account, which is a little bit further up here. All right, let's look at the profit and loss account. All right, so this is the profit and loss account or the statement of comprehensive income. Because it's a Sendirian Bahad, the term is called statement of comprehensive income. If you are using MFRS, then it will be called statement of statement of profit or loss and other comprehensive income. If you are using MPERS, it is statement of comprehensive income. So in Malaysia, both of these standards are very active. All right, a larger company uses MFRS. A lot of small companies use MPERS. Basically, a lot of things are same. Cash flow is exactly the same. There's no change. So this is the profit or loss. Okay, the group and the company. So if you look at this and you look at the bottom line, okay, basically this is the profit for the year. Now, this is the profit for the year after tax. All right, now taxation is another cash outflow. So we always take the profit before tax. All right, so if you look at the profit and loss account, this is the revenue, this is the cost of sales, this is the gross profit. Simple. These are the other income. These are all the other expenses, administrative other expenses. This is the profit from the operations. Now, from the operations, they paid finance costs of 11 million. And the share of losses of associate company is 800. So this is the actual profit that they made. So by right, you look at it, hey, very profitable, no, 38 million, good. So of course, this company is a healthy company, so it's not too bad. So we start with this From the profit and loss, we don't talk all of this. We ignore all this other income, all of this. We take profit before tax. So 38,222,000. All right. We go down to the cash flow here. Right. This is the cash flow statement. Okay, I'm going slowly so that I know it's very irritating to see a slide move on the screen, but here we are. So this is the statement of cash flow. Cash flow is 38,222,000. So that means to say this is the profit from the tax. But is that the cash collected? We don't know. Let's find out. So from here, all of the items that do not relate to cash, all right, or that have adjustments that need to be put inside. Adjustment for depreciation, supplies. I mean, this is a depreciation of the kitchen. Dividend income. Now, this is not operating. We take it out because we will put dividend income because operating is not dividend income. Huh? And also, sorry, the supplies kitchen is not part of operation. It's the kitchen, which is a fixed asset. Equity investment gains. Gain is not part of operation. Take it out of the profit because all these are already in the profit. So you look at 38 million. Oh, you mean the profit of this company is 38 million? No, it comes from many sources. So what is the source of the operations itself? So we are going to take up everything that is non-operational. Gain on equity investment. This will be definitely from the investment side, right? Disposal of investment side. Take it out. As you can see, we are taking out. All right. And also you have gain or loss on the disposal of property, plant, equipment. This is the loss. So this loss was included, but this loss has nothing to do with this thing. So this comes out again out of the operation. And then in interest expense is financing. Take it out. Interest income, financing, take it out. Retirement benefits, these are not at all anything to do with operation. Take it out. All right. Associate company result, nothing to do. That's investment. So take out unrealized gain on exchange. Take it out first. So at the end of the day, the real operating profit that you made in this company is 60 million. What did the profit and loss account show? It showed 38 million. So now you see a different picture. From 38 million, all of this did not come from a lot of the items here, all right, relate not to the operations. It relate to others. So the real operating profit is 60 million. Now, out of this real operating profit, did we collect all the money? Did we collect? All right. So then we look at further down. Inventories. Did we sell all the inventories? No. So we take the opening inventories, set off against the closing inventory, whatever is the difference we sold. So increase or decrease in inventory, that's the difference here. All right. So this means you haven't sold the inventory. Increase or decrease in receivables, opening receivable minus closing. All right. If the closing receivable has not been collected, this is not collected. This is increase. That means you have given more credit to the customer. So that means you haven't collected back. If it's a decrease from last year, it will have been collected back. Now it's an increase from last year, so it's more credit given to customer. Increase and decrease in payable. When it's a decrease in payable, that means that you have not paid your customer. You have paid. You have paid your creditors. You paid your creditors a lot more because you decrease the payables. So you see that your increase in receivables only went up by 7 million, but you kept paying your creditors and you paid them 18 million, right? So here they have some progress payments. So the progress billings also increased. So that's where this thing came in as well. So that is where you see the cash that is really generated from the operations of this company is actually 420 million, which you cannot see in the profit and loss account. Look at the profit. Look at the real cash generated. All right. Here mainly came from progress billings that they collected earlier, much earlier, 1 year ago. did not come into this year's P&L, went to last year, but this year they collected it. So it went into this year's cash. So you see, last year, the figure was not so great, but this year the figure is greater. All right, so you see that? You can take this out, you can see what exactly is their cash collected. So this is only operations. And as we go down a little further, all right, you then take into account the interest that is paid. Now we look at the financing part of it. Interest paid. Obviously, you're using other people's money, OPM, to run your business. You also must pay them their share. So this is the 15 million on the borrowings, all right? There's no retirement benefit here. Tax that they had to pay, otherwise the tax man is going to take you to court, all right? So the tax had to pay 11 million, and the tax have a small refund due to this and that. And then they also paid to foreigners, all right, some money. So they had to keep the withholding tax, though that goes in as well. So after all of that, the net cash after all these expenses went from 420 million to 392 million. So this is the amount of the net cash from the operating activities of this company. Noting one of the biggest cash inflow was not a current cash inflow. It was a previous year's billing that was collected in the current year. All right, so you can see the whole pattern here, how the cash flow is coming in. So having said that, this is all the cash flow from the operating activities, profitability and whatnots. Then what about their investing activities? We took out some of the things just now. All right, as you can see that we took some of the investing things out from here. So where did this go? So they must appear in one of the either investing or financing. So let's look at this. So they also did some property development. All right. So they are actually running some kind of an operation, and they got some other property to sell as well. So they have a dual operation in this company here, because it is a group. So different company in the group doing different. So they have some property development cost. So this is an investment, because this property is not the property that you are selling. They are not a housing developer. All right. As you can see that this is some kind of a company that is giving all kinds of what should I say, like hospitality business. All right, like hotels and things like that. So they also have buildings that they develop for their own self. So they invest in the building, then they rent out the building. So this is investing activities. So some more construction or work that is in progress that has not been built, so it cannot be an addition. So it's investing. So they spend money on investing. All right, dividend received from investments, disposal of the investment, and then interest received from investments. All right, not interest received from anything else, but from investment. We will look at the balance sheet. What investment are these? Okay, and then there is no disposal of land. There's no disposal of. There is proceed from the disposal of PPE, which is an investment, and then they bought a lot more of the assets. So they spent 13 million to buy. All right. So, and also, this is the amount they used in investing activities. This is paid out. All right. The biggest is went to construction activity. Cash went to construction. Now we must think carefully. If they don't have the cash, how could they pay? So that means they must have had the cash. And that's why we can see that they have already got 392 rolling in the bank. So they are doing all this, paying out the money from what they have rolling in the bank. So when you say 190, they are investing it. All right. So from there, we go to the next one, which is the financing activities. So they had been making money. So they paid dividends to shareholders, 14 million. So shareholders are very satisfied. Well, we put money, we are getting back a lot of money. Bank also, you can't get this kind of money. All right. Financing from borrowing. All right. So these are how much we got from the bankers, 191 million. All right. And that's the face value. Why face value? This financing that they got was actually not from a banker. They issued a private bond, and they issued to two major private investors. And these investors, in order to entice them to put the money in the company for them to do the construction work, right? They put in the money, so when the construction is finished and they sold off whatever, and the income they receive from whatever they've constructed will be used to repay them, right? So you use other people's money and you repay them. That's the best way, right? But the property belongs to you at the end. Now, that's how business is done. So here we have the situation where the dividends paid, financing from borrowings. Look at the financing last year. It was 207 million. It's gone down by 191 whenever they sell. And then financing discount. This is the face value. This is the bond discount, as you can see, a bond discount. All right. So in order to entice them, they issue the bond at a discount. So when they get back, they get extra 20 million. Now, if you are one of those who can come up with, here got two investors, come up with 100 million each, but I don't pay 100 million. I only pay a smaller amount. All right. So I'm getting a discount of 10% on the bond. So I pay only 90 million. But when I receive back, I get 100 million. In addition to that, the bond has an interest payment. I also collect the interest payment. So I got two ways. One, I get the discount on the bond, which I get back at the end of the day. The second, I get the interest. The third, I will get back my capital. Right? So you see, so that's why people willing to put in. So at the end of the day, that discount, then you can see that here, they repaid a lot of the borrowing. You see, even though they borrowed, as they got the money, they repaid back. Now, that's how you call prudent cash management. All right? They're paid back. Previous year, they're not paid. This year, they paid. So the net cash used in, brackets is used in, financing activity is 177 million. Right? From all this financing. So you see, very different from the operational side, right? And then that was the three items. So then with this, we have to look at what is the increase in the cash and cash equivalent? Meaning, what was the opening cash? What was the closing cash? Did your cash increase or decrease during the year? If your cash is decreasing, you're spending more money, not collecting it. But in this case, for the year, you are having an increase in the cash of 24 million. Last year, you only had 16 million. This year, you got 24 million. That means your business is profitable in terms of cash as well. Don't talk about profit and loss account. In terms of cash, you are actually collecting your money and keeping it. All right. And then this is where I said just now, there will be translation differences that have not been realized. Realized, not sorry, it has been realized. So this is the amount of the translation difference, 17 million. Last year was a gain, this year is a loss. It's a gain, this year is a loss. So cash and cash equivalent brought forward from last year is 56 million. All right. And the cash carried forward to next year becomes addition of all of this. The net increase, add to the opening, add to the translation difference. This will be your cash and cash equivalent of 99 million ringgit sitting in the bank. This is what we want to see. Because when we saw the profit, all right, let's go back to the profit and loss account to give a good depth of understanding to the statement of cash flow. All right. So what you see is, look at the profit and loss account. You are looking, the company making 17 million, but look at the cash at the bank, 99 million. So which tells you the right story? None of them tell you the right story. The right story is a combination of the profit and loss. Sorry, not 17 million here, 25 million. All right, this one is non-controlling interest, not 25 million to 90 million. So it's a combination because the business portion that is making the money, there is also debtors from the previous year who have paid, and so they brought in the cash. You have investment activities. These are not all investment. All right. Some of the one when you distinguish out, you can see exactly how much you make. So what was the cash at the end of the year? Let's go to the balance sheet and look at the cash at the end of last year. So this is the balance sheet, as you can see here, statement of financial position that runs on two sheets. So this is the assets. This is the current asset, fixed asset. That's a total asset. So let's look at what is the other side of the balance sheet, the equity and the non-current assets. Okay. Then we look at the profit and loss account. So the profit and loss account, so we made only 25 million. So what is the situation in the cash at the bank? Go back to the profit balance sheet and look at the cash in the bank. All right, so let me go a little bit slower. So cash at bank, 99 million. So you see, that is your cash and cash equivalent. Now, one more thing that you will find different when you do cash, when we do the this thing. We will look at that afterwards in the example. But for now, let's understand how it is done in real life. So you have a cash and cash equivalent here of 99 million. So look at note 16. Let's study note 16. Note 16 is a cash flow statement. This is a balance sheet. All right, this is a statement of financial position. Note 16 will refer to what cash and cash equivalent is in the cash flow statement. So remember the figure 99,845. We go to the cash flow statement now. We should see 99,845, right? Because that's on the balance sheet. So let's go to the cash flow statement and see whether we got the 99,845 there. Right, so this is the statement of cash flow. So the bottom line, is it 99,845? Sorry, further down. Look at the figure here. It's not 99,845. So we are going to say, hey, your balance sheet, your profit and loss, all wrong. It's 99,845. Where did you get this 99,432? How do you balance your account? Something is not right. Nothing is not right. Let's go to note 16 to figure that out, to understand cash and cash equivalent. Note 16 it shall be now. All right. So here we are, note 16, cash and cash equivalent. Blah, 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 blah. The long story come here. And then look at this figure. All right. The figure is, there are two figures here. Let me highlight this figure as well. All right. And this figure here. All right. So I will also put this figure. Let's highlight that as well. So 99,845 and 99,432. Which is the right figure, for heaven's sake? This is on the balance sheet, or this is on the balance sheet? This is on the balance sheet, right? Remember 99,845. But on the cash flow statement, it is 99,432. And that's why you need to do a reconciliation. So here you see cash and cash equivalent. Inside this cash and cash equivalent, there are fixed deposits. And these fixed deposits are called restricted balances. You know why? They have put deposits with a bank, and return, the bank gives a bank guarantee to the supplier for something. So, or to something, you need to give a bank guarantee. In this case, it's actually to Tenaga Malaysia, because the supply of electricity is huge. So Tenaga takes a bank guarantee, 150,000. And for the bank to give a bank guarantee, they want something to hold, right? So they just hold on to your fixed deposit. It's your fixed deposit, but it's restricted. Meaning, if you say, hey, I want the money now, can I upload the fixed deposit? Cannot. The guarantee is still in force. Unless you cancel the guarantee. You can cancel the guarantee, Tenaga is not going to supply electricity to all your buildings. What's going to happen? So therefore, you have fixed deposit, you are liquid, but you cannot use it. So is it a real cash and cash equivalent? No. It is cash, but cannot touch now. Cannot touch. Remember, 3 months is the one the threshold. Anything more than 3 months cannot. So this, you take it out from here. Take it out from the actual cash. And then there are other restricted ones as well. All right, long-term fixed deposits. So when they are long-term fixed deposit and not 3 months, you take it out. So 412,945 comprises of a restricted fixed deposit, cannot be used immediately. And it also consists of long-term fixed deposit, which cannot be used immediately. All right, they've also earmarked this for something. It's not encumbered, but it cannot use. So for this, take it out. The real cash and cash equivalent is only 99,435. And this is the real cash, right? This is what you see in the cash flow, 99,432. And the difference is that. So the next question we'll ask, then where the hell this figure went? Investment. All right? These are investments. They go into the cash flow in investments, okay? So that's why is it investment? It's a fixed deposit, but it is invested for a longer period of time. So it is not a short term, but it is invested, all right? It is one of the investment inside here. I did not break it down, but it's one of those invested amounts, all right, that is pledged somewhere. I need to find the breakdown, then I'll be able to give it to you. It's in one of these figures here, right? Which you will see from. I think maybe we have put it in a grouping somewhere. All right. I will get the breakdown and give it to you once I get it from my office. Let me get that for you. So it should be in investment activities. It cannot be in financing because it is not on this part. Okay. So that's where it would have gone inside the cash flow. Right, so it have been taken out, and that's why you'll see that the figure is 99,432 and not the other figure that is the total. So now we go back to where we came from and try to understand the picture. I'm going to stop sharing this, and I'm going to go back to the slide. Right? Get that out first. Okay. So let's go back to the issue of cash and cash equivalent. So this is the cash and cash equivalent I said, defined as short-term, highly liquid investment that are readily converted to known amount of cash and have original maturity of 3 months or less. No encumbrance whatsoever. So because anything beyond that will get out of cash and cash equivalent, we will see later where it goes into. All right, so we saw the 3 categories, and also we saw the indirect method being used, and we also saw the translation rates there, and we saw interest and dividends, that a lot of it went into financing that you saw just now in that company, because a large part is used for financing. All right, they did not put in operating because it's not overdraft. Overdraft interest is generally operating. When you take long-term loan, it's to finance something, usually, not always, but usually. So you finance the purchase of assets or something like that. So it becomes long-term. Long-term, that means the interest will go into financing. For daily operations where the overdraft goes minus, plus, and you get the interest, all that interest is using for operations. And if you are investing, all right, you're buying a long-term investment and you borrowed money, then that interest will go into investing from the investment income. So we must distinguish where this item goes inside interest, all right? Because financing could be for 3. All right, so these are the main elements that we have had. We came and stopped here. We are going through the next slide, which is slide number 8. All right, liquidity assessment. So why are we using what is the significance of what we saw just now as a real cash flow statement? It helps the shareholders, any other stakeholders, the banker, the creditor, or any other investor who has interest in taking up investment in the company. All right, foreign investors who want to buy up a stake, all of them are going to assess the entity's ability to generate the cash and cash equivalent. At the end of the day, not only generate profit, but generate cash. It's no use if you can generate profit but not generating cash. As I mentioned at the outset, in any company, whenever you want to look at the company, look at the profit and loss, look at the statement of cash flow. Are they collecting? So if their ability to generate cash is there, that is where we look at the liquidity assessment of a cash flow statement. All right. Now, performance evaluation. So we are also looking at performance evaluation, but in a different way. Why? Unlike the income statement that can be affected by accounting estimates, projected income, accrued income, all of that are actually estimates. When you talk about projects like what we saw just now, all right, when they are building their own buildings and renting them out or they are selling it. So again, performance evaluation, when you are building, the contractor is billing you on a progressive completion, right? Now, so there are stage of completion, how much is the estimate to completion? All these are estimates, all right? And this right portion for the year of that estimate goes into the P&L account on an accrual basis. But in the cash flow statement, those are not relevant. Did you collect the money? No, then don't put. Did you pay the money? Yes, then put it in. When you collect the money, then you put the money in. So it's all about cash. So therefore, the performance evaluation, unlike the income statement profitability, here that one is being affected by accounting estimate. The cash flow statement provides a direct view of how the money has been moving in and out of the business. You saw that just now. Later in the course, we will, as we have gone through other sections already, we will revisit that cash flow. So you get a broader, a wider, and a more in-depth understanding so that when you teach the students, they can understand what exactly is the significance of this cash flow statement. Something that has not been emphasized at all, but in real life practice, investors use a lot of cash flow to see whether you got money or not in the first place. Because at the end of the day, I am coming out with money if I'm an investor. I want to see, why am I putting money? Am I putting money in a company which is bad, which means I'm putting good money after bad? So if the money is good, I want to put. It's a simple philosophy. Bankers lend you money when your project is good. If something goes wrong, bankers want to get back your money. Or the bankers come and tell you, hey, your project is no good. Never mind, I lend you money, you try to make it good. No such thing, right? So it's the same token. When you are making money, people will put money, say, I also want to share in the bandwagon. But when you're making losses, sorry, I don't know you. All right, don't come and talk to me. Now that is human psychology, lah. Okay. So that is reflected in the cash flow statement. That's exactly what it is. All right. So investors here often scrutinize the operating activity section to assess whether the core business, the core, is providing sufficient cash to keep the business alive. The core business, the operating activity, that is actually the core. Is it collecting the cash? All right? Is the core collecting the cash? If the core is not collecting the cash, what's happening? The business not doing well. Okay, now to look at that, is the core business collecting the cash? Let's look back at the situation just now. I will go back to the item again. Let me just get out of this, and we will then go back to the Excel spreadsheet. All right. Is the core business collecting the cash? What is the core business? So the core business, as you can see here, is actually from the profit and loss account. This is a statement of changes in equity. Sorry, just close your eyes for a while until I go to the right page. Otherwise, you get a little bit groggy looking at this moving up and down. All right. So the core business here, all right, is the profit from the operations. Okay. Operation of 50 million. Now, that is the profit. They paid out finance costs, or rather accrued finance costs and others. So the profit before tax is 38 million. So did they collect the 38 million or not? This is the business of the company. All right, this is all the business of the company. Did they collect the 38 million or not? Now, don't forget inside here, also got things like depreciation, got non-cash item as well. But the investor is not going to look at all of that. We're going to say, all right, you need depreciation. You need all that items in order to keep the business running. You cannot say, I want a business without machinery and so no depreciation. I want a machinery, a company with machinery, but I don't want to depreciate the asset. Can or not? Then you're not providing for the replacement of the machine in due course. So when you don't add depreciation, what's going to happen? Your profit is higher. When your profit is higher, what's going to happen? You distribute it out as dividend. So the money has gone out. So now you come to replace on the machine. Hey, no money lah, because we distributed already all of that. But when you put a provision for depreciation, the cash does not flow out because you blocked it. The profit is reduced. You can only distribute to the extent of your profit, right? So the profit is reduced. So you pay less out. So there's cash in the business. So that's the logic. So when you're talking about profit before tax, can you make that money 38 million? So 38,222,000. Remember this figure. We are going to the cash flow statement. All right. So down to the cash flow statement here. Sorry. I went to the other one. Right. Sorry. Yeah. Okay. Cash flow from operating. This is what we saw. 38 million. Did we really collect back the 38 million? Okay. After all the adjustments. So you see the operations before this item of the progress billing here, we have collected 60 million. Take off all the depreciation, everything. We actually collected 60 million. So that means we are not losing. We are not losing at all. We are actually collecting the money. We're only setting aside out of the 60 million, setting aside for depreciation. So all these figures here are just setting aside. So we have set aside, yet we have collected 60 million. So would this be a profitable business? Yes, of course. Of course, it's a profitable business, right? For information, this company was incorporated in 1972, and they are existing until today. So therefore, that tells you a lot about this. And the dividends they are declaring is not small, okay? So it gives you an idea. The cash flow is good. So let's go back to where we came from. I'm jumping this because this is to give a proper perspective of things. All right, now let me stop sharing and I'll go back to slide. All right, here we are. Okay. So investment decision. Often scrutinize investors, the operating activities section, which we just saw, to assess whether the core business generates sufficient cash to sustain. 38 collect 60. Okay, that means sustainable. They are not losing money by not collecting money. So simple assessment, right? Now, what else is the significance of the statement of cash flow? A comprehensive view. So when used with other financial statement, that means to say when you're using your cash flow with the profit and loss and the balance sheet, as we did just now, jumping up and down from one sheet to another, like the balance sheet and income statement, it offers a more complete understanding of the financial health of the business. All right. At the end of the day, you have a person lying down, right, on the bed, on the hospital bed. Now, if he has got no heartbeat, no blood flowing through him, he's a dead man. All right. If he's got very little blood and his heartbeat is barely pumping, he's going to die. But if he's got a very healthy heartbeat and his blood is excellent, no blood pressure, nothing, he's a healthy person. Right now, exactly that's what is it. It all goes back to the heart. If the heart stops, everything else is working, doesn't no use also, right? The heart is the one pumping the brain. Now, you can be brain dead, but you still can be alive. So, but the heart is stopped, there's nothing you can be alive, right? So same thing. That is the financial health of this company. The heart is the cash. The cash is the one that drives the business, that makes people want to invest, that makes it motivational for the directors to make the company as profitable as possible, right? And look at it just now. You saw the amount of borrowings. The borrowings were wonderful. they were paid. The borrowings, let them make that kind of money without the shareholders having to cough out money in order to get big dividends. So you see, just now I told you, sometimes people say borrowing is no good. No, done constructively, done correctly, borrowings assist the business to grow. And you can see exactly in that set of accounts. All right, maybe after this session, after this training today, I will give you that set of accounts for you to keep so that you can remember what we went through. All right, don't worry, I'll send it to Puan Hasmida for her to circulate to you. Okay. So the next one is risk assessment. It provides insight into the entity's ability to meet the short-term obligation, thereby providing indication about credit or default risk. So you see, when you talk about risks in a company, one of the biggest risks is if you borrow loans, if you have creditors, the risk is you cannot pay the creditors. If you cannot pay, I told you the story. No goods are going to come and you cannot sell. The company goes on a downward spiral. Same thing with the bankers or any lenders of money. If you don't pay, they are going to take action. They will probably wind up the company or institute winding up procedures. All of that, negative things will come on. So when you're looking at a cash flow that's healthy year on year, all right, sometimes 1 year is not good enough to look at the cash flow because of gestation period of projects that may realize in the following year or the next following year. So investment in 1 year, realize in the third year. You have to understand the business to get the cash flow. All right, that's why you see suddenly there's a big cash flow in the current year in the example you saw just now. Actually, it's the previous year billing that eventuated this year and you actually collected it. It's not that you delayed, but project is like that. All right. So understanding the risks about the business and the projects and about the cash flow eventually, how it's flowing. So therefore, is it going to be a credit risk, a default risk, or what? Bankers are going to use this to understand the default risk. All right. So future planning. So management can use the statement to make informed decisions on capital expenditure. So using the amount of cash that we have collected, then you can say, let's keep that cash in the bank and do nothing about it, or shall we invest it? What sort of investment? Are we going to have a bigger capital outlay in the near future? No, next 1 year we are not using. Maybe we park it in the fixed deposit, or maybe we park it in some kind of bonds. A calculated risk bond so that you don't take too much risks. Or shall we just keep it in cash? No businessman will keep it in cash. All right. Even 1 day is money. All right. So therefore, they'll put it in some investment. So this is a future planning. And then we know that we are not doing anything for the next 3 years. So we park the money in next 3 years time, we download the money. And so that's what happens, right? Now that's the idea. And then the cash versus non-cash item. It helps in differentiating between actual cash transaction and accounting adjustment that have nothing to do with cash. One of those is depreciation. Depreciation is nothing to do with cash, yet has got to do a lot with business. As I say, sometimes people brush off the thing about depreciation, non-cash item. We just brush it off. But in real life, because you provided for depreciation, you provided for a replacement. You provided means the cash should not be distributed as dividends. All right. So if you did not provide, you actually would have distributed a dividend. And when the machine breaks down or you have to replace it, everybody look at it. Hey, where to get the cash? Ask the shareholder for money, can or not? Shareholders say, go to hell, I don't have money now. Then that's a risk, right? The business continuity is called to question. So that's why, even though they have no direct impact on cash, you want to understand whether they are provided for it. Okay, comparability, useful for comparing cash generating ability of different companies. Right? So now you can look at this company in the business of this. You can look at another similar company. Compare the two. Which one is better? Hey, that one making a lot of profit, no. Hey, but the cash, very little. Hey, this one, the profit is okay. Not as much as that, but the cash is very strong one, you know. I mean, this kind of type of things that investors will be looking and talking about. You see, so where would you invest? You will be attracted to something where there's more cash because it also gives you another indication that the management is very concerned about making sure their cash position is always healthy. So, would you invest in a company where the management is very concerned about keeping healthy cash? You would want to go there. All right. You may want to look at the other, a very profitable, no, but no dividends declared. Health cash is just like going, just standing by like that. All right. So, would you want to put in money? You will never know whether you'll get back your money. You never will know whether you get any dividends. So you see the risks and the rewards you're calculating. So this is the things we talk about comparability. The cash flow statement. Today you realize it is a very important statement in the real business world. All right. But many people don't understand it. Only investors know how to understand it. Bankers know how to understand it. All right. Investment funds know how to understand it. But an ordinary man on the street, investor in the stock exchange, he will always look at the profitability. Yes, it is important. Nobody say profitability is not important. I'm not for one the point trying to degrade profitability. No. All right, profitability is important, but cash flow is also just as important. You cannot neglect one. So you're calculating all the ratios, right? What is the price earnings ratio, blah, blah, blah. So again, price earnings ratio is a byproduct of an investor's confidence in the company. So an investor is now looking at the financials. If he looks at things and he feels that, hey, this company is quite good, you know, practically very good, the profitability is good, the cash is good, I want to invest. So if I say I want to invest, and many people like me have the same conclusion, want to invest, we will be buying the share. What will happen to the share price? The share price will go up, right? So the price of the share relative to the earnings of the company is the investor sentiment that is pushing the price up. All right. So that investor sentiment, where did it come from? It didn't come from, you know, just out of the blue. I'm talking about real, true-blooded investors. They are looking at all these numbers. So because the investor sentiment is good, the company price earnings ratio is different. But sometimes price earnings ratio goes on speculation, you know. Sometimes, you know, people say, hey, the fellow can buy one, no. The fellow can buy no, buy la, buy la. That kind of thing is a wrong price earnings ratio. So again, the idea is whatever you look at the price earnings ratio, look at the company as well. And that's what the students should be made to understand the depth of what the cash flow statement is relative to the entire financial statement. So if they can understand this in this kind of depth, I'm sure when they go out to work in the future, they will have this notion of cash is very important. I don't like to use the word cash is king because of the bad connotation it has. I would rather use the word cash is very important. I mean, in the true sense of the word, it is important. All right, in a company. So today we are doing that cash flow statement. Now let's carry on. I think we have a break at 2 minutes time, 10:45. So, but before that, let me just start off this. This is the cash flow statement. So long we were in the introduction. All right. So the statement of cash flow. What we saw, we have already visualized it just now. Try to visualize it again. I will go back off and on to the cash flow statement. Don't worry, because I want you to be very savvy with the cash flow statement. That is the most important document. The slides are just the information, all right? So for us, we are all in practice and we are looking at practical side of things in everywhere. And when we advise client, we are looking at practical side of things. So I'm trying to impart the knowledge of the theory and the practice together so that you can also learn something about how to look at it from the perspective of, you know, the real life situation. So the statement of cash flow reports the inflow and outflow of cash and the cash equivalent during the period. And there are only three broad classification, as we saw: the operating, the investing, and the financing. All three are required, all right, to do this, to run a business. You need investing, you need shareholders to invest in the company, you need financing, you may borrow money, pay the interest, or you may, put fixed deposit monies and earning the interest. So in or out is all financing. And also operating activities is your core business. So the classification made up like this is actually intended to allow users to assess the impact of these three activities on the financial position of the entity and the amount of cash and cash equivalent it has. So this is the gist of what we are moving forward from now on. Now, I did see a couple of questions on the question screen that I have on another screen. Let me read out the question and address it so that we can address it as we go along, so that we don't have a situation where, there are questions and there's no time to answer. Right, the question is on another screen. The question is by Shamsul. How about Aranu or gold investment? Is it cash or cash equivalent? Now, it's a very good question. So let me give you some thoughts behind this about how we should look at these investments. So if we are looking at, let's say, the Aranu investment, is actually, I believe, it's an Islamic gold-backed investment fund, right? It's a sort of Islamic gold-backed gold-backed pawnbroking or something like that. All right, so it's actually something like cash and cash. Is it a cash and cash equivalent? Is your question. Now, first, we must understand when you put investment in an Aranu, what is the purpose of it? Right, the purpose. You need to answer a few questions. Is it that you can easily be redeemed and get back the money? Is it easily redeemed? Because remember, it must be readily redeemed. And there must not be a significant penalty or a significant risk in the market. Now, what if the price of the gold goes down? There is a risk, right? So you have to think carefully whether Aranu investment falls into a cash and cash equivalent or outside the cash and cash equivalent. Let's consider a few more things. Maturity. How long is the maturity? All right, period. 3 months. Anything more than 3 months is out of the scope already. It will go outside of cash and cash equivalents, all right? And then the purpose for it, what are we putting the money for? In order to keep some, to earn some interest. So the question is, if the gold price change again, will that be having a problem? Which takes us to the most important, the valuation risk. Now, because it's backed by gold, like gold investment, the value of gold in Aranu may also be subject to a market risk. The market price of gold may be subject to, it could be affecting. So, and this will be mitigated if you have any agreement to ensure that you have a fixed return and a fixed price. Now, if there is an agreement on that, then you might want to consider it as part of the cash and cash equivalent. If not, you can't. All right. Now, that is the basic foundation of the Aranu gold investment, backed investment. Now, what about just gold investment as you already have? Basically, gold itself will not meet the requirements of what you call a cash and cash equivalent. Gold is not. Now, white gold is readily sold for cash, but the conversion rate is subject to market volatility. All right. So unlike other kinds of investment, which are more stable, there's a market volatility in gold. So the liquidity is that. Now, gold does not have a maturity date. So there's no such thing as gold matures in a time frame. So gold is there. All right, invest in gold, you can sell off the gold. Okay. But gold itself, the risk is there. All right. The gold is a long-term investment, usually held like a hedge against currency, hedge against anything, rather than a short-term cash liquidity kind of thing. And the gold fluctuates very significantly, sometimes even in a short period of time. So because of this, the risk of the gold price falling, there's no way you can mitigate that. So that will not qualify under the terms of the cash and cash equivalent. All right. So for that purpose, it will not really at all be a cash and cash equivalent at all. All right. So that is the question. I've answered. Some of you have a problem on the slide. Yeah. All right. So that's the answer. Keep the questions coming. Don't worry. I'll answer them during the breaks or after the breaks. When I have a bit time to have a quick cup of coffee while I'm reading your question. Okay, moving on. We just finished this slide talking about what is the function of the three statements. Now, on the next slide, we are on slide number 13 now. I hope most of you can see the slide moving. Now, while not stated explicitly in the standard, the presentation of operating, investing, and financial cash flow that you saw in the statement is all done in practice. You never have the standard telling you, first you must have operating cash flow, then you must have financing, and then you must investment or whatever. It is a standard practice being done by all companies, all right? There's never a set format that is precisely stated in the standard. So all they wanted to show is the total net cash flow on each of the headings that are shown. So comparative figures are always required. So you saw just now on the cash flow itself, we could do a comparison. Now, how important that comparison was just now for us, because it helps us to understand, all right, how the cash flow, why last year so little, why it jumped up, or because we collected this and there was a progress billing that's not collected last year and collected. So the pattern is clearly shown in the cash, all right? Now, also, sorry, I accidentally pressed the button and the thing went on. So the components of cash flow, operating, investing, and financing are the most appropriate to entity's business. These classifications you can see in MFRS 107, para 11. Okay. Now, for example, if you purchase, and now we have already seen some practical things, so let's understand some theory part of it from the standard, this one. The purchase of investment is likely always to be classified as operating cash flow for a financial institution. Why? Because for them, investment is another source of income. All right. So therefore, the purchase is operating cash flow. All right. They need the interest income as part of their operational business. But for a trading company, interest income is not the primary source of income. Profit is the source of income. So the interest will be investment income. Right? That's why you say it will not go into operating, it will go into financing. But for bank, it is financing. So the same item will play different roles for different types of companies. All right? A single transaction comprises elements of differently classified cash flow. Even one item by itself can be split into three. So when repayment of loan include interest and capital, when you repay a loan to the bank, you are repaying the capital and the interest. What are they? All right. The element reflecting the interest side, where do you think it will be done? Why did you get that loan? To finance your operations, operational side. Then the interest must go to the operational side. If you finance the loan or you took the loan to buy a machinery investment, then the interest will go into investment activities. So if you took the loan to run your business normally, with no fixed item, then it is definitely operational. So the interest will go into the operating activities. If it is a machinery, financing. All right. And where capital repayment must be, where there's capital repayment, that must be classified as financing. So whenever you take a loan, all right, from a bank, it's financing, right? When you repay the loan, it's also financing. So taking the loan, repaying the loan is financing. No two ways about it, right? Next one. Then remember, we say there's a direct method and an indirect method. So let's have a quick look at, just now was an overview summary, and now we go a little bit more detail into it. This is, as I say, bankers use it extensively because to banks, they are more interested in the actual cash flowing everywhere. All right. We are interested in the business itself and how the business is generating the cash from the various sources. There's the main thing is the interest income and all the other income that keeps the bank alive, different from trading. So they like to use this, but some companies like to use this. But the thing is that it's a choice any company can make. There is no prescribed statement that says that you must use one or the other. Or I mean, you must use what for which business. You can use either one. Banks can also use this, no problem. All right. Now, under the direct method, let me get the laser pointer. It's clearer. Here we are. So under the direct method, information about the major classes of gross receipts and payments can be obtained either from the accounting records of the entity, essentially on the analysis of the cash book, or by adjusting sales, cost of sales, interest in a similar income, and interest expense or similar charges for a financial instrument. Now, the direct method is that, remember, you are going to actually take the actual amount in the balance sheet minus anything outstanding. So from the accounting assets, all right, adjusting sales, cost of sales, interest and similar income and interest expenses, and similar charges for financial institution and other items in the statement of comprehensive income. So loan repayment, what is the interest element, the beginning and the end, how much was paid, all right, what was paid, that is the paid amount that goes in. All right, changes during the period in inventories and operating receivables, opening balance, closing balance of inventories, the difference. All right, that means used up. Operating receivables and payables, also how much was received, how much was paid, and how much of non-cash items. Other items for which cash effects are investing in financing cash flow. So any other items will be relating to financing cash flow. And also on the indirect method, so direct method, we don't worry so much, but it is a system, something in the standard. So we just need to understand it first. All right. But in practice, most of the students who come out to work will be using the indirect method. Most of the, if you look at Bursa Malaysia, and you look at all the audited accounts of all the listed companies, they all use the indirect method. All right. Very few. There will be one or two sporadic ones who might be using this. Now, the direct method actually comes from the very old system that was envisaged way back in the 1970s and 80s. They call that the source and application of funds. If you remember, if anyone you has gone back that during that time, it was not done in Malaysia. It was something in UK. They had the source and application of fund, and you had to add the cash and minus the cash, blah blah blah. It's a very cumbersome way of doing things. That was the predecessor to the cash flow statement. Right now, it's so much better. Last time it was a very cumbersome way of doing that, and so the direct method is actually directly flowing in from the old method. That's why they kept that method. So the indirect method is taking the profit and loss account and then working from there. And this is what we are going through. All right. So the indirect method arrives at the same value for the net cash flow from operating activities, but it does so in a different way, not directly, but working backwards from the profit and loss account, which we saw just now. All right. So from the amounts reported in the statement of comprehensive income or the statement of profit or loss and other comprehensive income. All right. There are two approaches for presenting net cash flow from operating activities when using the direct method. And the most common approach is, of course, adjusting the profit or loss for what that we saw just now, the changes in inventories, operating receivable and payable during the year, non-cash items like depreciation, provision, and the deferred taxes. Those are provision. deferred tax or provision, nothing to do with the direct tax. Unrealized foreign exchange gains, which you saw, and also undistributed profit and loss of associate. You saw something, profits of the associate that were brought in. And all either items for which the cash effect of investing or financing cash flow. So this is the actual amount this is the actual way we do indirect method of the cash flow. So once again, change in inventories and operating receivable and payable, non-cash item, depreciation, provision, deferred taxes, and also any other items where cash effect are investing or financing cash flow. All of this, we take it out from the profit and then put it in the respective, what should I say, containers. The investment container, the financing container. So take it out the profit container because they were all deducted earlier. Take it out and then put it in this container so the profit shows the actual operational profit for the year. All right? All right, moving on. Why the funds increase or decrease? Okay, very simple language. People ask you, hey, why your funds increase or decrease? Funds here is the cash flow. So basic rules for the increase or decrease in the cash flow, basic rules. So transactions that show an increase in assets. Last year to this year, there's an increase in assets. What happened? A decrease in the cash flow. Simple logic. Last year, 100,000 asset, this year, 150. Where did you get the asset from? Obviously, you bought it, right? When you bought it, you must have paid cash. So that's why there would have been a decrease in the cash flow, but an increase in the asset. Does the balance sheet change in total? No. It merely converts from one element of cash to another element of fixed asset. The balance sheet, only the components change, but the total balance sheet does not change. Does the profit and loss change? No. All right? It may not change. It may change if it is inventory. Any other asset, it may not change. All right? So therefore, again, you have to see what element of item, whether it will affect only the balance sheet or also the profit and loss account. All right? So transaction that increase in the asset, decrease in cash flow. You buy more inventory, you got to pay more. All right, that's a basic item. Now, we don't talk about I bought more, but I didn't pay yet, because of creditor. Then you got to counterbalance with the third item. All right, transaction that show an increase in liability will have a increase in cash flow. So this will counterbalance each other. Right? One is an increase in the cash flow, one is a decrease in the cash flow. All right. So really, when you buy goods on credit, two things happen. The increase in the cash flow counterbalanced by a decrease in the cash flow. So net, you have not paid for it. Now you have not paid for it, right? So you look at it from that scope. Now, transactions that show a decrease in asset, increase in a result in an increase in cash flow. So by the same token, if you sell your fixed assets, you get cash. So you have a decrease in your asset, increase in the cash flow. If you sell your inventory, which is also assets, all right, decrease in assets, increase in cash flow. But I sold on credit. The debtor haven't paid me. Where got cash flow? So fine. Go back also to the same thing, all right? Transactions that are going to actually show a increase in the current assets, all right? Increase in the current assets, as you can see here, all right? Will have a decrease in the cash flow. So these two will counterbalance each other. Increase in the current assets, inventory, decrease in cash flow. Okay? That means to say that your receivable went up, you have a decrease in cash flow. But you have sold some assets, you sold your inventory, but you did not get the cash. So these two counterbalance each other. Right? Very simple logic, right? So transactions that show an increase in liabilities will result in an increase in cash flow. Logical. If you have increased your liabilities, that means to say that you will have an increase in your cash flow. Why? Somebody is financing you. All right? Somebody is financing you. You bought goods on credit. You didn't pay, They're giving you money they're giving you goods for you to make money. So it's an increase in the cash flow in that respect. Okay. Similarly, if you give credit to customers, it's a decrease in the cash flow. You are giving them goods and they are going to use it for themselves, or they're going to sell it and make money. So it's a decrease in your cash flow. Okay, so that's why uh, a decrease in the liabilities, an increase in liabilities, increase in cash flow. When you decrease liability, you decrease cash flow. Same. You decrease liability. You pay off your creditors. Is your cash flow going to be increased? No, it'll be a decrease in the cash flow, right? So this is the token. I mean, this is the simple principle by which we can look at it. You don't need to learn this by heart or anything of the sort, but to understand logic. All right. That's what is going to be shown as. All right. Moving on. Operating activities are the principal revenue producing activities of the entity, and other activities are not investing or financing activities. All right. Principal revenue producing activities and other activities not investing or financing, they are all considered operating. So actually, they produce revenue. Okay. And it provides a key indicator of the extent to which the entity has generated sufficient cash flow from its operations. That means, have you got enough money from your operation to repay your debt, to pay dividends, and to make investment and maintain, not only maintain, increase your operating capability without a recourse to external financing. Look at this sentence very carefully. Remember the example we went through just now, the real life example. So, didn't the cash flow give an indicator of the extent to which it has generated cash flow? We saw the cash flow was a healthy sum. All right, it's from its operations, which include the sale of some items, and they took a debt and they repaid the debt. And they also managed to pay handsome dividends, if I might add. And also, they continue to make investment, there's money in the bank, to increase their operating capability. And they do not need to go to the bank for any external sources of financing. All right? So that's the situation as it were. Now, just to give you a little bit more background to that company again, at the last board meeting, which I attended in my capacity as an auditor, which they wanted me to attend, they are now expanding their operations elsewhere also. And so the money that they have, all right, only part of it is going to be used. They are going to have a second round of borrowings from the bankers in order to come up with the next project, so that whatever money they have here will not affect the existing project. Same company, same business, but another project involving quite a lot of money. So you see, they are able to borrow. The bankers are willing to give. They know that, it's a healthy management of funds. So you see, another aspect of the cash flow is it becomes so easy to borrow the fund. The bankers are practically waiting to give you money. The last round, they made good money. Now they want to make money. But they made money. They only made some part of it. Who made the biggest money? The company made the money. So that's the moral of the story here. All right, borrowings. So information about components of historical operating cash flow may assist in the process also of forecasting future cash flow. So if you're trying to project for the next 3 years, your last 3 years cash flow statement is a good indicator of how cash flow will carry on in the next 3 years. It's not a confirmation. It is not something that is cast in stone, but it's an indicator of how your cash flow will be in the next 3 years. All right. So that is how you will use that for forecasting, as prescribed in paragraph 13. So cash flow from operating activities generally result from transactions or other event that will eventually determine, is this company making a profit or loss from the operations, all right, or all from the operation. So these are called operating activities. So this section, we are focusing on the top part of the cash flow statement, which is the operating. All right. So cash flow from operating generally result from transactions that will result in profit or loss. So cash receipt from the sale of goods and the rendering of services. Sale of goods and rendering services. Obviously, cash receipt is your operation, right? So what sort of service? Let's say you are running a window cleaning service. You are cleaning buildings, large buildings. You get contract to clean buildings, 30,000, 50,000 to clean buildings maybe every 3 months, 6 months, whatever it is. All right. Those are all rendering service. Those are your core operations. Sale of goods, we all know. Cash receipt from royalties, fees, commission, and other revenue. Now, if you have, cut a music, all right, or you have made some recipes, or you have something, you give you give to people the right to use all your recipes, or you collect royalties from the sale. They are cash receipts. Your business is to make all these things, and sell them in that same offer in the case of intangible asset royalty income. So that also is your operating if you do that. All right, your primary this thing. Fees, commissions. If you are a salesman, you earn commission. If you're an insurance agent and you earn commission, those are your operating activities. All right. And cash payments also, these are receipts, payment for supplier for goods and services, and payments on staff salaries. All right. For to and on behalf of employees. So you may pay to the EPF. All right, you are not paying for them. All right, you may pay the company share, but you also deduct from the employee and pay to the EPF, and that's why it's called on behalf of employees. All right, cash receipt and cash payment of an insurance entity for premiums, claims, annuities, and other policy benefits. So, what do insurance business do? They collect money for what? Premium. What do the premium? They insure you. All right, that if there's any peril or anything that happens to you or whatever, they need to pay out. So they collect and they pay from this pool. Of course, they got reinsurance and all that. We won't go into that area. So this is where in the business of insurance, all the premium receipts and collection will go into the operational side, right? Cash payment or refund of income tax. So you pay the income tax or you overpay, they refund you back. Unless they can be identified with financing and operating activities, you will put them inside operating. All right, all tax will go in operational. All refund of income tax is cash, also goes into operational. Now, as I say, unless you can put them into the respective item like investment and financing, most likely it's not lah. All right, because even if there is a very small amount. So anyway, it's always going to operation. So cash receipts and payment from contracts held for dealing or trading purposes. So any contracts that you are buying and selling, or you are also used for dealing, all this cash receipt, if you are in the business of dealing, all right, trading, all the investment, you're buying and selling investment, all the contracts for buying and selling, you are actually like a broker. So if you're a broker, it's your main operating income. Okay. All right. Now, that's why, for the reason that we just said, the cash flow from operating activity is also called the default category. It's like a big pot. Everything that cannot go into the other two pots will be thrown in the pot by default. All right, by default, it goes in here. Taxation goes by default here. But if you can slowly peel out a little bit that comes out from the other pot, then you put in the other pot. All right. So any cash flow that does not fit into financing or investing activities will automatically default to the operating activity. So we must know this. So unless it's very clear, it's financing, very clear it's investment, those gray areas automatically default to operating. Okay. Now, things like example, acquisition related costs in a business combination. What is acquisition related cost? Look, company A wants to buy over company B. So company B Before you buy over, you need to get the accountants, you need to get the tax advisors, you need to get all kinds of consultants. You need to pay them fees. They don't come cheap. So when you pay them fees and before you finalize the arrangement, the pricing, the methodology to take over that company, all these people are paid. Where are those fees? Are they operating? Not really. Are they investment? You may not buy that company. At the end of the day, the deal may not go through. All right. So is it financing? Definitely not. So it goes into the pot, right, as operational. Okay, so these are things that they will also be classified operating cash flow because there's no related asset that would justify classing it as an investing cash flow. If you have not yet bought the company, all right, so you have no asset yet. So all this will be written off. Written off where? Must come from your operations, lah. Okay. Now, when the second one, when an entity holds security for loans, and these loans are for dealing or trading purposes, this is holding them. They are similar to inventory held for sale. Therefore, any related cash flow on those holding loans and security, buying and selling loans, then they become operational. All right. Usually, what do you mean by buying and selling loans? Buying securities and loans. Now, you buy loan. God, when you buy shares, it's equity. When you invest in bonds, what is a bond? It's a loan. You are buying loans, all right? Bonds are traded on Bursa Malaysia. And what is a bond? A bond is you give money to another company. You invest your money to another company. In return, you get interest. Okay? You don't get dividends. You get a contractual flow of income in the form of dividends. Sorry, in the form of interest. Okay? So that is why you can buy and sell loans. So buy and sell securities are shares. So shares and bonds, when you buy and sell, trading. You are trading in bond, then all these expenses are operational. All right? Definitely, they are trading. So you may not put it as operating. You may not put as investment unless it is a big amount that you are investing and it's not you are not trading in it. You are keeping the investment, selling it when necessary, then it will go into investment. Because investment means you need to invest in order to earn. All right. There's no period of investment that you need to put, but you need to invest. But if you're buying and selling, you're trading. Okay. Now, you don't invest in inventory, do you? You buy inventory to sell. The inventory may be sitting there for a while. It's because it's slow moving inventory. Do we call that investment? No. Buy the same token shares and stocks as well. So cash advances and loan made by financial institutions are classified as operating activities since they relate to the main revenue generating activity of that entity. So cash advances and loans made by a financial institution are classified as operating activities in financial language because they are banks, they are loans. All right, can banks say this is a financing activity? No, operating activity. What is the income from giving loans? Interest income. Is interest income financing activity? No. Is that trading activities? All right, quite simple this. Next one, the proceed from the sale of property, plant, and equipment, which are included in the cash flow investing activities, are an example of an item that enters into the determination of the profit and loss and is not an operating cash flow. So you see, just now you saw why I took out certain items from the profit and loss account. All right. Any proceed from the sale of property, plant, equipment in the accounts, we put it as sale. Okay, and it'll automatically profit from the sale will go into the P&L account. Loss from the sale will go into the P&L account, right? We don't have an account to say the investment account or something, no. But in the cash flow, we adjust it out. All right, so we will adjust it out into maybe investment. All right, that is the adjustment we did in the cash flow statement. So the first part from the operating, you saw why I got so many adjustments. So now you'll slowly begin to learn that adjustment clearly. And after we have finished some more slides, we will revisit them to remember what we are just going through in the slides. All right. So proceed from the sale of asset previously held for rental. You have an asset you are holding for rental and you sold it. are classified as cash flow from operating if the entity routinely sells such assets in the ordinary course of business. Now, if you are holding assets, a lot of assets, a lot of this thing for rental, you got properties for rental, right? So all these rental items, you sell off maybe one. What is rental? You're operating this thing, right? Now, if you are running a trading organization and you got one particular building which you rent out to people, that is not your operation. That becomes your investing activity. So the rental received will become investment income, investing activity income, right? And if you sell that building, it'll be proceeds from investing activity. But if you are actually having a lots of property, you're running the business of property rentals, then the property is your operation. So it will not go to any investment. It will go straight to operation. So you have to also understand what is the nature of operation of the company, which afterwards we will go back to that set of account and try to understand the nature of operation of that particular company, and also try to understand why they seem to have some construction work and sell and make some money. Why? How does that jive in? We will go to that also. Okay. So this one is done. The proceeds of assets previously held for rental are classified as cash flow from operating activities if the entity routinely sells such assets in the ordinary course of business. All right. All right. Now, cash payments to manufacture or acquire property, plant, and equipment held for rental to others, right? If you manufacture or acquire PPE and then you rent it out to others and then eventually sold in the course of business, they are classified as rental from operating, right? You manufacture. Why do you manufacture machinery? Because you're a manufacturer of machinery. So you sell it, right? Operational. If you buy property, plant, equipment, and you rent it to people, and at the expiry of the period or when the property, plant, equipment gets old, you sell it off. Let's say you are a machinery rental company. You buy a lot of tractors, you rent it out or you lease it out to contractors who can't afford to buy all this heavy machinery for their earthworks, for whatever building construction. So they rent it for the duration. So you own those. So you're buying this machinery for rental. So are they PPE? No, they are inventory. All right. Are they inventory really? So if you acquire this PPE for rental, you are actually PPE. You're earning money. And subsequently, you sell this PPE is operational. All right, operational income. And that's why if you look at MFRS 117, all right, on PPE, you will see that the classification of PPE is assets held for your own use or for rental. The words are clearly there, for rental. Now, we all know under MFRS accounting, when you hold a property for rental, it is supposed to be investment property. So should it not be classified under investment property? Now, if it's going to be investment property, then you have this different scenario altogether. Okay, you're not buying a property for rental and selling off. You're not buying, this sort of thing. You're actually buying a property, rent it and sell, rent it and sell. That is a different type of a business. There's a shade of difference there. So if that shade of difference applies, you're actually buying, renting, and selling, then you may not want to actually put it under the investment property, because investment property is basically for rental income and capital appreciation. Here is rental income and sale. There's a difference here. That's the slight difference, right? So there's a fine line between the two. But that is the reason, if you look at the standard, they tell you clearly for your own use or for rent, right? Okay, those that are routinely sold in the ordinary course of business, then they are, of course, operating activities. Now, you can check all this in paragraph 14 and whatever paragraphs that I've listed it down there. Now, why funds increase or decrease? We saw a quick summary just now. Let's go into a more detailed one now. So operating cash flow, short form is OCF. That means cash flow from operating activities. All right. Operating cash flow is nothing but cash flow from operating activities. So OCF or operating cash flow will give a company a good look on what is going on behind the scenes. See what is going on behind the scenes. We are doing a lot of business. I see activity going on in the business. I think we are making money, right? But when we come to something else, why we got not enough cash? The business is running. Why are we not making money? Why I can't see the cash? Or the businessman will say, you're doing business, where's the cash? I can't see the cash in my hand. This is the very basic of what a businessman says. Where? Show me the color of the money. Show me where. You say we are making money. Ask the accountant. You show we are making money. Where? Where? Every time our cash balance so little only. Oh, where are we making money? Now that is the businessman's brain. Actually, the businessman brain is running the cash flow statement, the profit and loss, and the balance sheet all in one configuration. So he can't see it. All right. Maybe the company actually made money and they are expanding. So the money is going toward purchasing of fixed asset. He does not think that way sometimes. But some of them think, yeah, I remember we made some money. That's why we invested. So there are different types of people. But let's understand this better now. All right. OCF is considered the cash version of a net profit. That means operating cash flow, because it cleans the profit and loss account of all the non-cash items, depreciation, all throw it away, and also non-cash expenditure, accrual, all to throw it away. The depreciation, amortization, non-cash working capital item. You saw the working capital item we showed separately. All right, take it all off. So then you will see the cash version of net profit. Now, it's because in the cash flow statement, we make all these adjustments, we can see the actual cash from operating expenses. That's why it's called the cash version of the net profit. Okay. So the operating cash flow is the most important gauge of the real profitability than net profit. Because if you want to use cash as your basis, there's very little opportunity to manipulate the operating cash flow to appear more or less profitable. All right. Now, many companies, when they do fraudulent activities, very basic of basic fraud that you see everywhere is this. This year, our profit very low. So I want to push up the profit. So what they do, they push the sales up by putting in all kinds of situations. All right. Next year's sale, genuine sale, bring forward to this year. They call that channel stuffing. All right, bring forward to this year. Genuine sale. But I bring the invoice this year, show the goods as goods in transit, and only next year is delivered. But the other party only ordered next year. But I'm still finalizing this year. Not good, the profit, so I bring in. I could also do another thing. I could create an invoice or a number of few invoices. Right? Sell goods, take the goods out, send it to my friend's factory and say, can you park the goods for a few days? After the end of the year, I bring it back. All right. So at the end of the year, I got sales increase. The other one is outright fraud. Increase the sales by fictitious invoices and increase the receivable. Right. Now that one quite easy to get, easy to catch. But the point is this. Is that easy to manipulate? Yeah. A P&L account can manipulate. But can you manipulate cash? You say your sales went up, this went up. I can't jive it. You see, your receivable went up, but your receivable cannot collect. Or is it collectible? So where's the cash? Where is the cash? That's the question. All right? Where is the cash? Whatever figure you put in the P&L, I don't, in the balance sheet, I don't care. Where is the cash? This is where you can see that it's difficult to manipulate cash. So when you use the cash flow statement, this is the real situation. You say your sales went up, a lot of profit this year. Where's the cash? All right. That's why it's fraud. You can easily catch. All right, moving on. It's easy to check on creative accounting or fraud because unusual earnings or manipulation of the books easily spotted by using the operating cash flow. Nobody will go for investment cash flow or the financing cash flow. Everybody, when they know the criminal mind, right, the mind of the simple fraudster is simply this. Why do you want to fraud the company? Who are the people who want to fraud the company? If you look at the ACFE reports, all right, the AC is the Association of Certified Fraud Examiners. That is the foremost organization in the world for fraud. If you look at their data, the highest people who commit frauds are the top line people. The ones, the CEO, the directors, the whatever, chief financial officer, all these are the biggest frauds committed by them. The small frauds are the staff, right? Take a little bit, steal one computer and go, steal some little bit of cash, $5,000. But the big ones go to the top. And that is a fact. You can read all this in report. I'm not saying it for the fun of it. So therefore, when you want to do creative accounting, most of the creative accounting in the world, all right, under the frauds, there's so many frauds that have been committed all the way in the world. All of them, cash was the biggest issue. Nobody checked on the cash. Yet, they went on for 10 years, 12 years. Look at Enron, look at the Parmalat, look at the Wirecard scandal even now. Look at so many other world cases, WorldCom, all of this thing. All fraudulent cases, Toshiba, many, many companies in the world. If you study the fraud, which I've done, and I'm giving talks on the fraud for auditors, if you understand the fraud, this exactly is the problem. The cash is not there. Simple, right? Cash is just not there. But unusual earnings. All right, next one. The bottom line on the operating cash flow, right? Operating cash flow is just one component of the cash flow of the company. Why? Because there are three: operating, investment, and financing, right? So, but it is one of the most valuable measure of what? The strength of the company, the profitability of the company, and more important, long term. Investors putting money for long term. They want to get returns. Investors put money not to get short term return. They want to earn dividends. They want to multiply their capital so that when they sell, all right, and they cash out of the business, they make huge amounts of money. It's simple as all that. All right. So operating cash flow is just one of the components, but is also the most valuable component for the purpose of measuring the strength, the profitability, and the long-term outlook. So basically, as what we talked this whole morning, it is moving money, cash flow moving in and out of the company for every year. All right. How much money came in? How much money went out? So on balance, all right, at the end of the year, what's your cash and cash equivalent? Has it increased over last year or has it decreased? Minding the fact that it does not mean decrease means bad, increase means good. That you have to interpret a lot of details. For instance, the simple thing you say, hey, last time your cash so high, now went down already. What happened? No, it could be many things. It could be you are investing on a project now, which returns will come out in maybe 2-3 years' time. If you don't invest, you are not going to get additional funds. So you invest, or you're investing in new machinery, which will take time to pay off. So all of these things will bring the cash flow down. But is that permanent or is that temporary? So there are many ways to find that out. By looking at the cash flow statement, I see you're invested. Why you invest? You're making so much loss. What for you invest? That will be very stupid. Then you know the investment could be faulty. But if the company is making money and the machineries are getting old, or the company is making money, the demand is still there, there's a potential, they might want to invest what they made so far in new machinery so that they can expand the market. So does not always mean the cash flow down means it's bad. But on the contrary, it could also mean that the cash flow down could be no good. All right, you're not collecting your debts. So it goes on a study of the respective financial statement. That's what I am trying to highlight now. So later when we go back, we will study all this on that set of account. All right, what is the way, what's happening, all right, from beginning to end, what's going on, what's the nature of the business. You see, you get a bigger picture. So the cash flow statement itself is one element. Maybe I will call it the heart of the body. Right, so we are now examining the heart. Because the heart is pumping, I can move my hands. All right, because the heart is pumping, I can talk. So this is like that. Because the cash flow is being produced by the company, they are moving bigger and bigger. All right, and because the cash flow is not moving at all properly, or the is being drained out somewhere else, the company is not growing. All right, the heart is not pumping well, so I'm speaking like that. You see, so it all looks at the health of the company. So the bottom line, operating cash flow is just one component, but there's also the one of the most valuable measure. Always remember this, of the strength, profitability, and long-term future outlook. That's what is the purpose. I think when we are talking to students, this is what they need to understand. Now, a lot of interns who come to my office they can do a cash flow mathematically very easy. This minus this minus this minus this. Okay. All right. But when you ask them to explain in great detail, they do explain, but very, what would I say, a very surface way of doing things without understanding. So if you probe them a little further, they don't quite understand already beyond that. So you know the depth of knowledge, all right? By putting a dipstick in, oops, the knowledge is only that much. I expect the knowledge that much more, okay? So it measures money flowing in and out over a specific period. And unlike the net profit that we see in the profit and loss account, the operating cash flow takes out all depreciation and amortization, which can misrepresent the actual financial position in terms of cash. In terms of cash, all right? So it is a good sign when the company has a strong operating cash flow with more cash flow coming in and then going out. This is general. More cash flow coming in than going out. Naturally, isn't it? As an individual, you earn income every year. You want an increment, right? So as you go on in the life, your earned income will be increasing. Your cash inflow will be more and more one year to another. So that's what you want, right? Now, how you spend is another story. Now, then we are not talking about how to spending it, but there is an inflow. So companies with a strong growth in the operating cash flow, when you have a strong growth, more likely than not, they have a very stable net income. Okay, now that is the general trend. It's not a rule, but it's a general trend. So that's why when you look at this, you have a second nature in looking at a set of accounts. By every day looking at it, becomes second nature. Look, oh yeah, this company I think is quite strong. I think this company is not so bad. Now, the one that I gave you is a relatively strong company. All right. And later we will go through it and understand more why it is a relatively strong company, even during the COVID times, what happened and what did not happen. All right. And they have even become bigger now. As I told you, they are going to other projects now. So strong cash flow, what management should watch when they're analyzing whether the company is strong financially. And so to understand this, the following items are very important to track in the operating cash flow. All right. Accounts receivable. This is the most important. Now you sell the goods. Cannot collect a useless one. Okay, you sell, you must collect. So changes in accounts receivable on the balance sheet from one period to the other is where you call the last year's closing balance of receivable, this year's closing balance of receivable. Now, last year is a certain number. This year is an increase. What does that mean? You're selling more on credit. All right. Doesn't mean you're collecting. Doesn't mean it's no good. Well, there are two reasons. One is you are collecting, but your sales are expanding more. So your receivables will correspondingly increase, but you're collecting. But the other argument could also be that you are increasing your sales but not collecting. Which is the real thing? For that, you need to go a little bit deeper into it. All right. Very easy to understand this once you get the main principle. So I'm taking you on the baby steps now. So if the accounts receivable decreases on the balance sheet, this means more cash has entered the company because the customers are paying the debts. Receivables, paying, come down, right? So definitely coming down now. Now, the amount by which the account receivable has decreased is then added to the net earnings. That means the net cash inflow. Okay. Now, if the account receivable increases from one period to another, the amount of the increase will be deducted from the net earnings, profit before tax, because although the amount represented the accounts receivable are revenue, they have not been received in cash. So even though you sold the goods, you didn't receive the money, isn't it? It's deemed to be you didn't sell the goods. If you didn't sell the good, your net income or the profit before tax will go down. By the same token, instead of doing the long-winded way, we work on the profit and loss account and add or deduct them accordingly. All right? Now, I think I saw some questions. Maybe I'll just take the questions, as I go along. Since it's there, I might as well do. Now, this is a very interesting question. My question is how companies can use cash flow to manipulate the accounting profit. How to use cash flow to manipulate accounting profit. First, I don't think you can use a cash flow to manipulate accounting profit. All right, unless you do fraud. Now, even then, it will appear. Even if you take out the money and then buy the sales and goods, it will appear. My view, my personal view, it is not possible to use cash flow inside the company to manipulate accounting profit. All right, you can pump in outside cash and push up the sales. All right, by pumping in cash and increasing your sale, and after that, giving a credit note and taking the sales out. You can do that. But when you do that, I can detect it straight away. Because when you put in money to increase your sale, the goods have not gone up. All right? And if the goods have not gone up, there will be a distortion in your gross margin calculation, gross profit ratio. All right? Then there's a distortion. I will go further to find out. Did you buy the goods for this additional purchase? Because it did not go out, where was the goods coming from? You see, it can be tracked. Unless you put very marginal small sum, in which case you wouldn't do it. But if you put any large sum of money to push up the sale, bank in the money, all right? First issue an invoice, bank in the money, and then next year, credit note, take out the money, pay back. That can be used. But the goods must also take. So if you want to do that, then you must do all the way. You have a place, okay? Bank in the money, put in this thing, actually physical goods sent out of the company. Somebody acknowledged, yes, I received the goods. So there's a genuine, in inverted comma, genuine sale, right? There is money that went in. There is also goods that went out. But I have no intention of selling because nobody bought the goods. I want to increase my sale. So 31st December, let's say a financial year end, my sales has gone up, my cash balance has gone up, all right, everything has gone up. My accounts look beautiful. I go to the bank and I want to apply for a loan. Yeah, I say, yeah. That's fraud, isn't it? In that way, you can do it. But following year, your goods will come back and the sale will be refunded. All right. So now, if you ask me from the position of a cash flow situation, you can do that exactly, Dr. Ahmad. But from an auditor's point of view, what we always look for is exactly this. After the year end, we look for returns of goods. All right. So let's say we are doing the audit in April, okay, because the year end finished and then April. So we do the audit. We're looking at any returns from January to April. Whenever we see return coming back, hey, why was this return? Huh? Because those are fraud. Genuine returns are different from fraudulent returns. When you're an auditor for as long as me, it feels in your bones. Okay, so you can see that there has been return. On the top of it, the whole, cash also returned back to them, and the goods came back into the store. So what is the purpose of doing this? Obviously, fraudulent activity, isn't it? I would look at other aspects of the balance sheet, all right, before the sale. I would look at it in the last 2, 3 years. Maybe the company has been stretching at the limit and they have not enough financing. So they want to go to the bank. But knowing that giving that kind of balance sheet, the bank is not going to finance you because you don't have the resources to pay. Now, if I pump up this and make my balance sheet look so much better, the bank will say, oh, I see you're turning around, maybe. And they start giving you some facility. All right. What actually has done? The bank has been defrauded. Okay. Now, auditor's duty is to look at this. If the goods are returned, then this is a fraudulent activity. All right. Now, it could be a genuine return. It could be a fraudulent return. Now, that's a judgment to make. Why was it returned? Now, some directors or some companies are even smarter. Okay. Now, I'm teaching you how they defraud the company. Yeah? Since you asked the question. They know that the auditor is coming in April. Keep the goods. Don't send it back. No, why so stupid? The auditor will look for it. So the auditor look for it, don't have. Genuine sale. Okay, finish already, gone back already. Come back next year only. Next year line Charita. All right. He's going to look from January to April. Goods came back in June. So as an auditor, we are not stupid. So when we see suddenly the sales are going up, I go back to last year, not me, as an audit principal. We go back to last year from the day we pulled out the audit. See whether any returns after that. Sure, you get caught one. Cannot escape. Hey, how come return in June 1? See? So your question is, can you use the cash to manipulate profit? Yes, you can. All right. But it can be detected. Because ultimately, cash will be taken back by whoever it is, unless he has put it in the company. And if you want to put in the company, why so stupid to run through this? Put it in a share, sir, or give it as a preference share, or give it as a loan to the company. It's so simple. Why do this? All right. So that's my question to you, sir. All right. Now, the next question on the way, I'll just answer one or two first. Let me just put a sort of a tick. So I know I've answered the question. The tick is just for answering. Otherwise, we don't know which one sometimes. Now, is the proposed dividend included in a cash flow statement? Now, a proposed dividend has not been paid. So it is never included in a cash flow statement. If it was ever included in the P&L account, if it was ever, all right, then it would have been taken out because the profit would have been reduced. So at that level of profit adjustment, the proposed dividend will be taken up. Cannot go into P&L account. Sorry. Cannot go into the cash flow statement. All right. We must remember that the proposed dividend is only a liability when the payment is approved or the dividend is approved. All right, for payment. It will not be a liability if the payment is not approved for dividend. Where do I get this from? From the conceptual framework. All right, we must understand what is a liability. You see, when you do a proposed dividend, what are you doing? You're debiting the P&L account with a proposed dividend and sorry. Terbalik. You're debiting the P&L account with a proposed dividend and crediting the liability proposed dividend on the balance sheet. That is inconsistent with the conceptual framework of a liability. A liability definition broadly is this: a present obligation as a result of a past transaction and from which economic resources are going to outflow. They tweaked it a little about 4 years ago, but fundamentally it's the same. It's a present obligation. A proposed dividend is not a present obligation. It's a future obligation subject to the proposal being approved by either shareholders or whatever. So you can never have a proposed dividend in a P&L account today, all right? Unless the proposed dividend is also payable straight away. Then it's a dividend payable. All right. So therefore, proposed dividend will never come into the cash flow statement. Right? Not now. Although although I've answered the question, if you feel you're not clear or not sure, you can continue to ask further on this. All right. Don't think that just because I answered the question, I'm not going to go back. My purpose here is to make sure everybody understands everything. So don't worry, I'm okay with it. You can ask me again if you're not sure. Okay. Now, next one, what is the most suitable timing to do cash flow? 1 month, 6 months, 1 year, because cash flow is based on actual money spent and received and excluding future commitments on spending and receiving money. Now, here we are talking about slightly different. When you're talking about doing a cash flow, I believe you're talking about a cash flow projection. All right, if you're talking about cash flow projection, uh, usually you will do it 1 year, 6 months to 1 year. 1 month cash flow can be done. All right. But once you've got a 6 month, then you can break it down to 1 month. You cannot see things in a short span of 1 month. All right. That is pure cash flow. Huh? Nothing to do with what we are talking today, cash flow statement. Huh? So 1 month is good. 1 year is an estimate, because the cash flow here you're talking about is a cash flow projection. All right, cash flow projection. So no, don't do projections for anything beyond 3 years, because by default, the financial reporting standard says that, all right, that anything is only about 3 years. You cannot see anything beyond 3 years. Even if you see, it is merely, your own conjecture. It may not be really, because it's very hard to identify. But your question is the most suitable time to do cash flow. I believe is the cash flow, cash flow projection. All right. So if you want to do a cash flow projection, 6 months, 1 year is more than enough. Based on actual money spent and received, but excluding future commitment on spending. Yeah, that is purely a cash flow projection. Now, if I'm to relate what you're saying to the cash flow here, it's totally irrelevant, because we do accounts every year. All right. So annual accounts is where you do the cash flow statement. So I can't match yours with the cash flow statement, but I believe is a cash flow projection. If not, maybe you can ask a further question. Okay. Next one, if the cash flow is more reliable report compared to statement of income and expense statement thing, I would not say a reliable report per se. I would say that in terms of looking at the accounts, you must look at it both in the balance sheet, profit and loss account, and the cash flow. You must look at the cash flow. You must look at the profit and loss account. Now, let's look at the cash flow just now, the example. It has a huge cash at the end of the year. Doesn't mean it's good. Maybe the operations are not doing well. Maybe there was something else. So actually, the best way to do it is look at the profit and loss and the cash flow together. All right. The balance sheet comes on later. The profit and loss is the most important. Is it profitable? Whatever money I'm putting in, is it profitable? If it's profitable, are they collecting the profit? Are they collecting the money? Jump to the cash flow. All right. If they are collecting the money, let's look how healthy the balance sheet is. You see, you go in that way. If you find that you look at the cash flow, looks like they're making good money, but you cannot see whether the profit and loss account is making money. So if the profit and loss is losing money and they are getting some other income here and there, that is not the core business. The core business is losing money or very little thin margin. All right. It's cutting it very, very thin. So it is not using the cash flow as a reliable. Cash flow cements the profit and loss account. Without the cash flow, the profit and loss account, is useless. So as I said earlier, as an investor, you will look at the P&L. The next thing you want to look is the cash flow. If you say you're making all the money, I must see the cash flow. If you didn't say you're making the money and your profit is very bad, I wouldn't want to see the cash flow. Because even you're making, losses and your cash flow is healthy. To me, if I invest money, the core business is making loss. Am I going to drain the money making loss? Now, where did the other money come from? We don't know. See, where is the logic? When the company is making loss, your cash balance is going up. unless you have earlier money just kept an investment. But earlier money cash investment, the new shareholders probably won't get much of it because your share is going to be diluted. So again, the main thing is still the profit and loss account. Then you must go to the balance sheet and look at it together. Then sorry. First is the profit and loss account. Then the cash flow statement. Then look at the balance sheet. Don't look at the cash flow itself first. It may be very misleading. Okay, I hope I answered that question. All right, so this will be answered. The next one is, I would like to know more on abnormal cash flow. Abnormal cash flow. Now, fraud. The only way you can do an abnormal cash flow, in my opinion, is fraud. Cash is fixed. Now, if I earn 1,000 ringgit a month, I only have 1,000 ringgit. And if I spend about 600 ringgit a month, I have 400 ringgit left. Now, suddenly I got 5,000 ringgit in my pocket. That's an abnormal cash flow, isn't it? Where did I get it from? And if I get it, I should have recorded it. If I didn't record it, there's dubious money coming in. Maybe somebody gave me a gift. Then it could be a gift. All right. Or somebody just say, Nemana, you take, I got too much money, and then I'm just happy. But otherwise, there is no abnormal cash flow. You see, abnormal cash flow cannot jive in a business because you're taking from the profit and loss account. The bank account transactions are all fixed by cash. So if any abnormal cash flow, it must have gone into the bank. And if there was a cash flow coming into the bank, a large sum of money, which is an unexplained amount of money, right? What would you do? You'll be wondering, where's the money from? Okay. And then you'll be asking question, where is it from? So where did that money come? Oh, somebody gave me as a gift, so they become a gift. So you are recording that as a gift in the company. So I will have, gift in the P&L account, and that will become a normal. Abnormal is normal. So other than that, abnormal cash flow cannot be fixed onto this cash flow statement. They flow in tandem. Cash flow statement is directly like a double entry system here within the framework of the balance sheet and profit and loss account in the context of MFRS 107 or IAS 7. There is no abnormal cash flow. All right. I mean, I don't know how to get abnormal cash flow other than a fraudulent cash flow. Okay, if there's any more, you can just ask me. Yeah? All right, the next one. So proposed dividend can only be disclosed in the notes on the account. Yeah, that's exactly the case. If you wanted to show a proposed dividend, you can state anything in the notes on the account. It is not a liability. It's just proposed subject to the approval of whatever it is. Do not ever put a double entry. That was olden days. All right, before the conceptual framework came up, you can put all of them. So now it does not come in. So you're right. Please put it in the notes on the account. So this is correct. All right. Okay. Keep the questions asking. I will continue with my this thing. All right. Inventory value and cash flow. An increase in the inventory. So again, very simple. Increase in the inventory means technically you pay money to buy, right? Now, if the inventory is paid with cash, the value of the cash will go down. All right. The value of if it was paid in cash, the increase in the value of the inventory unsold is deducted from the net earnings because unsold means you didn't collect back the cash. You paid for it, but you didn't collect back. If you sold it, you collect back. So a decrease in inventory means what happens? Added to net profit because you're selling, your profit is going up. Okay. So if inventory was purchased on credit, not yet paid, increase in accounts payable will occur in the balance sheet. And the amount of increase from 1 year to another year will be added to net profit. This is all the direct method of doing it. Okay. And the same logic goes for tax payable, salaries payable, and prepaid insurance. Now, all these are actually money going out. Now, if an item has been paid off, then the difference in the value owed from 1 year to another is subtracted from the net profit. All right. When the value is paid off, it's taken from the net profit because the net profit is going down. You pay salaries, deducted from the profit because the profit is going down, right? Now, investing activities are defined as acquisition and disposal of long-term assets and other investment not included in cash equivalents. All right? Investing means what? Any investment not included in cash equivalents. So invest in something, you get an asset, right? So let's carry on. The separate category of cash flow allows users of the financial statement to understand the extent to which expenditure has been made for resources that are intended to generate future income. All right? Investing. Investing is you put money intending future income to come back. So that's why you cannot always say a negative cash flow is bad. You must look at the picture. Negative cash flow could be the result of making good money, reinvesting it to expand the business. Otherwise, how else can businesses expand? All right. Borrow money from the bank. Yes, you can expand. If you got your own money, you also can expand. So if you use your own money, you may have a very slow net cash or a negative cash flow. But as what the standard says here very clearly, it is simply to generate future income and cash flow. No invest, no money come. All right. In bad English, no invest, no money come. All right, you invest, sometimes money come, sometimes lose money. Okay, simple. So that's the logic of it. So cash flow arising from investment activity include payments to acquire, that means to get, and receipt from the sale of property, plant, and equipment. We are talking investment activities. Property, plant, and investment, property, plant, and equipment is an investment. You buy machinery, chairs, tables, all right? Maybe even a painting for the wall of your office. It's an investment to generate cash flow. Some people say, how the hell can a painting generate cash flow? So you bring in foreign clients, important clients. They are coming to the office and looking at your office. If your office looks like a rundown shed that is used for storing wheelbarrows and charcoal, and your office is there, what impression would they get? Go to hell. We can't do business with an idiot like this, right? You come to an office that is big, beautiful, has paintings, except Mona Lisa. All right, because Mona Lisa, the painting is so huge, right? It's so huge, don't waste your money on it, right? Anyway, so put the paintings. What people will get is, I think this company is doing well. I visited the company. They are good. So I would like to do business with them. So maybe that painting did the trick. All right. We don't know. But the thing is that, I mean, I'm just speaking in that context. Payments to acquire all of these are actually to generate income. So all this property, plant, equipment, intangibles, intangible. So now, what is an intangible? Suppose I want to manufacture something and I need a technology for one of the parts there. And I cannot copy that technology. I can't manufacture. I get somebody to give me the patent rights. All right. I pay money and get the patent rights to use that whatever technology to manufacture that portion. So that is also an investment. You can't see, you can't tell, where's your technology? Oh, there, this book of paper, here's my technology. You paid 3 million for that? Yes. But that is what they are trying to say, is an intangible. All right. And all of this have future generation of income. And so you cannot see because the cash flow went out first. The person who is holding the patent right say, I give you this patent for 5 years, but I want upfront payment of 5 million, 1 million per year. You want, take it, don't want, never mind. Because the more complex the patent you have to do, so okay, I pay first now. All right, I got the patent right really well. Now it's for me to generate income, right? So then you'll see a negative cash flow. Is it bad? All right. Yes, it's bad if you cannot produce the goods and your factory fails, cannot produce. Bad, 5 million gone. Yes, but if the balance sheet and profit loss shows that the sales of the new product are picking up, then it's good. So you see, everything is relative. Everything is one big. What would I say? a beautiful dance going on, everybody moving in the right direction, the right way, not one going that way, one going that way, and look like I don't know what they are doing there, all right, fighting or what. Okay, so it's a beautiful, graceful dance. Everything moving in the right step, right direction. That is how you look at a financial statement. Are all the things in the balance sheet, profit and loss, and state and cash flow, are they in harmony with each other? So that's the interpretation. That's what it is. So when you do the cash flow statement, this is what people are looking at. So you see how important a cash flow statement is, right? And sometimes we can misrepresent the cash flow statement or be misunderstand the cash flow statement. So that's why I'm trying to put the focus very correctly for everyone to disseminate to the student that it does not mean that negative cash flow is no good, but it does not mean also that the negative cash flow is good. In order to come to a judgment there, you got to look at many more things. And that's other things which we are looking at. That's why today our cash flow is running into the P&L, running into the balance sheet, and running into all kinds of things, right? All right. Now, and other long-term assets like payment and receipts relating to capitalized development costs or self-constructed property, plant, and equipment. So if you're going to spend a lot of your money to expand your factory, you've got one factory, but your capacity is full and your demand for the goods is high. So what else can you do? You say, I got land. So we have been making money. So the idea will be put some of our money to construct a newer factory next to us, all right, and borrow some of that money from the bank and some of the cash that we have. So on balance, we have still a balance of cash left. The bank is also funding us. So together we make the factory and then we earn, we pay the bank off, and then the factory belongs to us. We still generate income. The capital value of the factory is still there. On balance, we earn much, much more than the bank. So you see, that's why you have to look at it from the point of view of the operations of the company. All right. Sometimes the notes on the accounts will tell that the company has entered into agreement, to with this thing to construct a factory, blah 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 blah. It will tell you your capital commitment. Then you look at the cash flow projection. Sorry, not projection. Cash flow statement and the profit loss account. Are they able to sustain, or are they borrowing too much? Because when they borrow too much, then you're talking about equity ratio, equity to debt ratio. If your equity to debt ratio is not quite balanced and is way out, your equity is so small, your debt is so small, all the business that you do, all the money that you make is being paid to the bank. In other words, you're working for the bank. You're paying all the interest to the bank. Shareholders get no dividend at all. Now, that is the other extreme. Okay, so by looking at extremes, we know where on that balance we should be. So this is why when you invest in all this, it takes a while to recover. So negative cash flow may not be always bad. So payments to acquire and receipts for the sale of equity or debt instrument of other entities and interest in jointly controlled entities. All right, so any payment to acquire, receipts from the sale of equity or debt instrument. That means you invested in shares, invested in bonds, debt instruments. All right. All these are actually investing activities. Advances or loan made to repay to other party, loans to directors, loans to related companies, very, very normal, related company loans to and from. So this will be either cash flow from investing or to investing activities, right? Where you are investing into the other parties, all right? This is not loans by bank, but loans made to your associate companies. We see related party companies have a different notion. When you put money in a related party, it's your own company. All right, it's a related party. It's probably connected with you by shares or connected some way or another, always by shares. So you're helping a related party transaction. So in that respect, is an investing activity. All right. And loans, yeah. And on the next slide, payments for and receipts from future contracts, forward contracts, option contracts, swap contracts, except when the contracts are held or dealing for trading purposes. So whenever you are investing, you are going to invest in something, right? So all this, I invest in a future contract. Now, if I'm going to trade it, I'm going to be speculating on the futures contract. I want to speculate on the palm oil, let's say. I pay a deposit. I don't pay for the full price of palm oil. I go into the futures market. I buy palm oil for 6 months delivery time. So therefore, in 6 months, the palm oil will be delivered to me. So I buy it at today's price. Now, what I'm hoping is that the price of the palm oil on the market goes up. So I will sell. I don't take delivery of anything. Buy, sell, buy, sell. I pay a deposit only. So I make money, or I will lose money. Now, that is not actually, really, that is speculative. But it is, is something you must be very, very careful. And they are actually trading. So these are investing, buying and selling. But if I invest in the palm oil market, because I want physical delivery of oil, I am manufacturing, I'm a manufacturer. I manufacture soap and, shampoos and all of that stuff related to using the palm oil. All right. So what do I need? I need large quantities of palm oil. And I don't know whether in the next 6 months, the palm oil price will go up. So I go to the futures market, I buy palm oil there to take delivery of it in 6 months' time. Am I investing? No, I'm not. I am purchasing palm oil and hedging my palm oil price so that if it goes up or down in next month, 6 months, I don't have to worry. I can do my costing already. But if I am buying palm oil to sell on paper, that is investing activity. That's why payment for and receipt from futures contracts, forward contracts, option contract, swap contracts, swapping a fixed rate interest with a floating rate interest, and that is to hedge your bond fair valuation on the balance sheet or on the profit and loss account, except when the contracts are held for dealing, trading purposes, or the cash flow is classified as financing. All right. So all of these will be inside the investing activity. All right. Now, only expenditure that results in a recognized asset. Watch this very carefully here. Some people make a mistake here. Only expenditure that results in a recognized asset in the statement of financial position, you can classify as investing activity. All right. So when you're talking about buying and selling options, option to purchase palm oil, and I sell off the option within the period of time, did I actually have an asset at the end of the period? No. So can I classify that as an investment activity? No. It comes under trading or operational activity. Okay. So, but if I buy that palm oil futures to be delivered in 6 months and it delivers to my store, am I having an item on the balance sheet? Yes, inventory of palm oil. Okay, so that is an investing activity. So only expenditure that result in the statement of financial position eligible for classification. Now, then again, we have to understand what is this investment for? Okay, the cash flow relating to cost must be recognized as an expense cannot be classified within investing activities. All right, so only expenditure that that result in recognized asset are eligible for classifying as investment activity. Any other cash flow relating to cost recognized as an expense, not recognized as an asset, recognized as an expense, that will be not an investing activity. All right. The result of what you pay, is it going to the P&L account or is it going to the balance sheet? If it goes to the balance sheet, recognized as an asset, the rule is investing activity. If it goes to the P&L account, the rule is expense. So it cannot be investing. Where does it go? The default can, which is what? Operating activities. Okay. So payment for exploration and evaluation activity, exploration and evaluation, and research and development that are recognized as an asset are classified as investing cash flow. When entities that recognize expenditures and expense would classify the related payment as operating cash flow. Now, exploration and evaluation, all right? So you're spending money, blah, blah, blah. You dig, 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 dig. You come so much digging, you almost see the center of the earth. Maybe you went through the other side of the earth, nothing inside. So all the expenditure, would you put in the balance sheet? No, right? Expense it out of P&L account. So exploration and evaluation activities that end up in the P&L account, what do? They are actually, what sort of this thing? Operational. Now, suppose I explore and I discover that, oh, there's a lot of oil. I want to explore there. A lot more oil here. Oh, a lot more gas there also. So all of this expenditure that I explode, where would I put it? In the balance sheet to be amortized, right? So when I put this cost in the balance sheet to be amortized, it becomes an asset. So is that investment activity? Yes. Okay. So you see, this is how you recognize this. All right. So moving on. So the purchase or sale of an asset, loan or made to a related corporation or received from related corporations or any payments related to a merger or acquisition is included in investing activities. All right. Purchase or sale of an asset, loan made to a related corporation or received by related. Remember, all these are actually related party transaction. You are investing. Payment for merger and acquisition, M&A, sorry, is also investing. Changes in the property, plant, equipment, other assets or investment that relate to cash from investing. All right. So all these are flow coming on. That means you sell the PPE, cash flow coming in, investing cash flow that has been realized. Now, cash changes from investing, when you invest something and you sell it off, are called a cash out item. I cash out. Because cash is used to buy the new building or short-term assets. All right, no, from investing, not selling, from investing. You are taking cash out to pay. And you're actually investing in the PPE, building, short-term asset, and marketable. So the money that came out goes into an asset, right? So it is investing. But when the company sells off the asset and the transaction is considered, then what is called cash in. You sell, cash come in. You buy, cash out, all right? And this is calculated for cash from investing, okay? So this is all investments. Moving on, financing activities, the third activity, all right? Now, financing activities are defined as those activities that result in changes in the size and composition of the contributed equity and borrowings of the entity. Contributed equity means what? Share capital, all right? Contributed by the shareholders. Nowadays, you don't have what you call a value on the shares issued. I mean, a par value, so to speak. So it becomes a contributed capital because first batch may contribute capital. You know, those days they say 1,000 units at 1 ringgit per share. So you pay 1,000 ringgit. The next one who contributes may be paying the next batch after a few years, maybe paying 150 a share. So we say premium of 150 and you got the share premium account. All that is now hari ini dalam sejarah because all that has already been eliminated by the Companies Act 2016. So as a result of which, all capital can be paid at $1, 150, whatever the company asks for, right? All that is called contributed capital. So the standard says that the information useful in predicting claims on future cash flow by providers of the capital to the entity. So contributed equity, you will not pay back. But if the company is going to wind up, they will all be paid back, all voluntary winding up. Okay, borrowings, you know exactly how much to pay. So information on financing cash flow would indicate the extent to which the entity has a recourse to external financing to meet the operating and investing needs in the period. So therefore, when you look at financing cash flow, what the bankers, what anyone looking at that portion of the cash flow statement is vis-a-vis the balance sheet and profit and loss account again is that, do you have capacity to borrow? All right. If you do not have capacity to borrow, that means to say you cannot expand.